tariffs are the wild card this year. It is what everybody is talking about.
Policy is sort of rolling out, and consequences and decision nodes are happening in real time.
The question is, are there any carve-outs to those tariffs? The inflationary effect will be less the more you get carve-outs.
If we see some really big increases in inflation, that's going to be very disturbing.
There seems to be a lot of panicking about it, but maybe we need to kind of be more rational. There's a lot of devil in the details.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Let's get you to the weekend. Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Friday, set to snap a 2-week losing streak on the S&P 500. Your equity market bouncing back this week following the biggest one-day gain in about a month. This morning, negative by 0.1% on the S&P 500. On the Nasdaq, we're down about 0.1% also. Through the week, this market not trading on what the president has said. This market is trading on what he didn't do.
What he didn't do was exercise some sort of massive and specific tariff plan on a lot of governments that a lot of people were worried about, which is the reason why you're seeing a relief rally and the reason why you're seeing the dollar fall to the weakest going back to mid-December. At the same time, you have to wonder if this is a market that is trading on trying to take out tail risks and just look at the possible upsides rather than anything else, whether it's inflation or whether it's perhaps the removal of a tariff threat.
There's an uncomfortable calm gripping this market. You can feel it as we just look through every single threat. Peter Tchir of Academy, who joined us a little bit later, writes this. My take is the president was talked down from what he wanted to do by some of his advisors.
And some of those advisors, Jonathan, are not even in place officially yet. You have Howard Lutnick in the room where he hasn't even gotten his confirmation vote. But in order for Trump to maybe do what he wants to do, he needs to wait for his ambassador at USTR, his commerce secretary, to be in place. What I saw yesterday was almost a copy and paste of the executive orders he put out in his first term, except, put in every single country instead of China. And it's a measure, a directive to go investigating. There were no tariffs yesterday. Not a single tariff was put on, and that's why this market ended up rallying.
Let's go to the schedule for today. It's another busy one. So at 8:30 Eastern Time, we'll get U.S. retail sales. At some point this morning, you'll hear from the Vice President, J.D. Vance, at the Munich Security Conference. On any other day, this headline from this president would be front-page news. From any other president, this headline would be front-page news. I'd love to have Putin back in the G7. Russia should be sitting at the table. Some of the headlines from the news conference yesterday were stunning. We'll meet with China and Russia on military spending. We want to cut the military budget in half.
He is talking about the possibility of both Russia and China helping to end conflicts and create a more stable backdrop, which is exactly antithetical to what we've heard out of the European Union leaders as well as President Biden before Trump. There is a real question here about whether this brings us closer to peace or further away. You have a lot of analysts saying, actually, this probably opens the door to more negotiations. And then you have the Europeans who are saying, actually, this pushes us further away. At the same time, you are correct. It just shows how much the vibe has shifted.
It's going to be an incredibly tense Munich Security Conference when J.D. Vance and General Keith Kellogg go in there and meet with their European counterparts. Many will say, why is Trump being a bit warmer or softer towards President Putin? The Wall Street Journal this morning, editorial board, scathing. Mr. Trump is treating Putin and Russia unlike any other negotiating partner. His usual method is to make maximalist demands. But some of them would maybe say he's giving Putin an off-ramp because his end goal is peace.
We'll hear from the Vice President a little bit later on this morning. We'll be taking those comments live right here on Bloomberg TV. If you are just joining us, welcome to the programme. Equity futures just a little bit softer on the session. We're down 0.1%. Coming up on the programme, coming up this hour, we'll catch up with Jim Bianco of Bianco Research as stocks look through trade threats. Jeannette Lowe of Strategas as Trump takes aim at Europe. And Daan Struyven of Goldman Sachs on his outlook for energy markets. We begin this hour with stocks near all-time highs as markets look through tariff threats. Jim Bianco of Bianco Research is watching 10-year bond yields and writes the following. If rates are steady, then 10-year bond yields should continue sideways before heading above 5% and the curve will steepen. Jim joins us now for more. Jim Bianco, I want to go to a quote from Michael Hartnett of Bank of America and get your thoughts on this take this morning. We say hot 3% US CPI in January is a blessing in disguise for both bonds and stocks. Michael and the team go on to say rising inflation means Trump must go small, not big on tariffs and immigration in the coming months to avoid fanning a second wave of inflation. Jim, would you agree with that take?
No, I would not. I mean, we all know the phrase is you're supposed to take Trump seriously, but not literally. And that's what I think we've seen in the market in the last 24 hours. They're torturing themselves to basically, micro read what Trump has said, but take him seriously. He intends on doing tariffs, and we are going to get tariffs, and they're going to come. And as much as we want to try and talk ourselves out of it, they are coming later this year. And I might add, markets get things wrong all the time. It convinced itself in January 2020 COVID wasn't going to be anything, and it was. It convinced itself in August of 2020 that, the yen carry trade unwind was the biggest deal we've ever seen, and it wasn't. So it gets things wrong a lot, and take Trump seriously.
So, Jim, with that in mind, as you look at bonds and stocks, and you look at stocks close to all-time highs and bond yields near the low end of the range for the year so far, what do you think's more vulnerable?
Oh, I think the bond market is probably more vulnerable at this point. The hot CPI number, I think, is still a tell that at least at a minimum, the road to 2% is now, we've been talking about the last mile for 2 years, and we're probably going to have to talk about it for another 2 years before we get there to 2%, that we've got sticky inflation. And if we've got sticky inflation, the Fed is probably going to be done cutting rates, if not maybe one more this year, although I think they might be done for the year, meaning that the funds rate is still going to end the year with a 4 handle on it, even with one more cut. And if the yield curve continues to steepen and we see some kind of normalization of the curve, which we've been seeing for the last several months, that means that you could be pushing the 10-year yield above 5% sometime later this year. And I still think that that's in the cards.
Jim, when you take a step back, it feels like it's a little bit of a numbing environment. There is so much noise. You have, on one hand, about 3 days ago, we were talking about that inflationary risk, and you would have had a lot of compatriots talking about 5% Treasury yields. At the same time, you got inflation data that looked bad on the surface, but people got enough comfort from the individual details to say, actually, this means that disinflation is intact. How do you strip out the noise and have conviction about an inflation call and the possibility of expectations getting truly unmoored?
Well, I think if you look at the way that the markets have been trading, and if you start with the stock market, the S&P is at the higher end of a range it's been since 2 weeks after the election. It's been trading in about a 5,800 to 6,100 range for, like I said, over 2 months, and it's just at the top end of the range. And the same thing has been happening with the bond market too. On November 15th, we were at 450. We're 453. We ended the year at 456. So there's a lot of noise, and the markets move around a lot. Yesterday was a big individual day in the stock market, but the trend is still sideways. And that says that that's still a market that is, has little conviction or is unsure of where to go next. So it sees all the news and it's not really reacting to it other than having big days here or there, but moving sideways. And I think ultimately it's going to give away to there's going to be tariffs, there's going to be a little bit more inflation, and interest rates are going to go higher.
Jim, when you talk about the inflationary impulse, are you really attributing that to policy? Or do you see something in the internals of the data that a lot of people are just dismissing as highlighting some sort of pressure that everyone is closing their eyes to?
No, I see something in the data. Every time we have a financial crisis or recession, and we had both in 2020, the economy changes. Change is not worse. It's not dystopian. The big change that happened in the economy coming out of 2020 was remote work. Over a quarter of the country is now doing remote work, and we know what Jamie Dimon's attitude about that is from a couple of days ago. He doesn't like it at all. But it is here. It is not going away. And that is a fundamental change, not only to the way we work, but also to the way we live our lives. And I think that that is building excess pressures on prices and leaving us with higher inflation. Not 8, 10 or Zimbabwe inflation, but more like 3 to 4% inflation. And core CPI just finished its 45th month in a row above 3%. So we've been seeing that kind of pressure, although we continue to try and tell ourselves that, no, we're going to go back to 2%, that, we're going to return, as Jay Powell says, to a pre-pandemic environment. The cycle changed, and we're in a different cycle right now.
Jim, I just love to quickly get your thoughts before we end on what you actually think is going on with tariffs, because you say the market should be taking Trump seriously, and they didn't, but he didn't actually sign anything formidable yesterday. It's an investigation into these countries. There was not a single tariff placed yesterday, and my read is that he's in negotiating mode to get some sort of concessions, especially out of the European Union. Would you not agree with that?
Yeah, I think tariffs are leverage, and I think they are big leverage. And I think that when it comes to negotiating with our partners, whether it's Canada, Mexico, or the European Union, Trump holds more cards than they do. And I think that these tariffs are a threat, and he wants something else. Now, in the case of Europe, I think what he wants is he wants more security arrangements. He wants them to spend 5% of their budget on defense. And he even said yesterday he wants them, when they're spending 5% of their budget on defense, to buy more stuff from defense makers in the United States. So I think that all of this is more leverage than an external revenue service to raise revenues. I think he wants some of that too, but I think it's really about negotiating, and we need to understand that that's what he's trying to do.
Hey, Jim, great to kick off this morning with you. Appreciate it. Jim Bianco there of Bianco Research. We'll talk about Jamie Dimon a little bit later on the programme. The comments this week, absolutely scathing. There is no chance that I will leave it up to managers. Zero chance. The abuse that took place is extraordinary.
With respect to, well, are you talking about
work from home,
or are you talking about some other things that he was talking about? He has not liked work from home. He thinks that not only is it bad for morale, he thinks that younger workers have a harder time really getting up to speed. We saw kind of a waffling back and forth at Citigroup. A whole host of different organizations are basically saying, look, get back to work, and they have the leverage to do so now because many people suggest they have more of the upper hand than they did, say, 2 years ago.
We'll get to that story in about 20 minutes' time. We've also got to spend the morning unpacking that news conference yesterday. There was one piece of that news conference that jumped out to me, and I didn't see a single journalist follow up on it. The president turned around and suggested that the Europeans had offered to drop their tariffs on autos. It's kind of bizarre, that moment. Then he looked to his side to try and confirm the news. No one followed up. I've seen reports about the Europeans offering to do that, but I haven't seen any confirmation of it whatsoever.
Well, there was one journalist who did ask the White House about it, and what I got back was an FT story from 1 week ago where a European Parliament Trade Committee individual, person that heads it, told the Financial Times the bloc was willing to lower its 10% tariff and put it closer to 2.5%. So potentially, when we say Trump is in negotiating mode, this is what he's talking about. He wants to make that gap much more in line on where the U.S. Tariff is on European car
Did you
imports.
get any clarity on whether the president was referring to the report from the FT or whether they'd heard directly from the EU?
I didn't get much clarity, but what I believe at this moment is that the president thinks this is where there's potential to do a deal on autos with Europe.
This is the reason why a lot of people are benumbed to this, and the reason why this is increasingly noise. Because it sounds like it's the big one, guys, this is going to be it, and it comes out with zero details in a sense that maybe we're going to study something and something will happen. And people take it actually as being a positive because it's not a blanket tariff across the board. You get into the details of what may or may not be negotiated, it's all fungible. This is the reason why this is a market trading sideways and doesn't know how to respond and is just looking how to cut out the noise and look at the positive.
Stocks very close to all-time highs. Equity futures down here by about 0.1% on a session so far. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Let's cross over to Danny Berger. Hey, Danny.
Hey, John. Just want to give you the details of what we heard and didn't hear. President Trump ordering his administration to impose reciprocal tariffs on U.S. trading partners. Specific tariffs would be customized for each country and could take weeks or months to complete. The tariffs would go into effect as soon as April 1st, with the announcement of the date seen as a potential opening bid, as Annmarie was saying, for negotiations. Meanwhile, TikTok is available to download in the U.S. once again after Apple and Google restored it in their app stores. The decision follows a letter from U.S. Attorney General Pam Bondi, which said that a TikTok ban would not be immediately enforced. There's still no guarantee, though, that it will survive in the long run. Trump had ordered a 75-day review period on Inauguration Day. Hermes sales surging, wealthy shoppers splurging on their handbags over the holiday season. Sales exceeded expectations, jumping 18% in the fourth quarter. Hermes also outperformed its peers like LVMH, Gucci Kering, retaining strong pricing power and demand among the wealthiest consumers. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes' time. I think Annmarie said it earlier this week that Hermes is not Gucci, right?
They're not Gucci. I thought they were going to do well. They're in a league of their own. People line up to buy those Birkin bags.
Stock is up by about 0.9% this morning. Up next on the programme, Trump taking aim at Europe.
We think the European Union is wonderful. We all love Europe, love the countries in Europe. But European Union has been absolutely brutal on trade. You know, they're doing something else. European Union's been very tough on our companies.
We'll get the latest on Europe in just a moment. We'll catch up with Jeannette Lowe of Strategas from New York City this morning. Good morning. Check out the euro. It's on the longest winning run of the year so far. Could be day 4. We're just about unchanged at the moment. Euro dollar 104.68. Under surveillance this morning, Trump taking game at Europe.
They haven't been treated as good. You know, we think the European Union is wonderful. We all love Europe, love the countries in Europe. But European Union has been absolutely brutal on trade. They have a 20% VAT tax, which we're considering to be similar or the same as the tariff. Plus, they charge lots of fees. And, you know, they're doing something else. European Union's been very tough on our companies.
So here's the latest this morning. President Donald Trump calling out Europe once again as he moves to impose reciprocal tariffs across the globe as soon as April. European Commission President Ursula von der Leyen saying the EU will react firmly and immediately against unjustified barriers to free and fair trade. Our team coverage starts right now. Bloomberg's Tyler Kendall in Washington, Ollie Crook in Munich. Ollie, I've got to come to you as the Munich Security Conference kicks off. What on earth are the Europeans saying back to some of these headlines, not just on trade, but on geopolitics, on foreign policy, on security as well?
I mean, John, half of the people I'm interviewing, I'm informing them of the latest developments coming from Donald Trump. Even people that are running major companies within Europe in the defense sector, when you have Trump talking about having defense budgets for the United States, China, Russia. I mean, this is just all sort of a fire hose of information that the people here are trying to make sense of. And they really are having a very difficult time doing it. I was just speaking to a very senior European official who characterized the peace deal, the negotiations, as I can't really say on air, but it was very, very negative, saying that basically J.D. Vance in his speech might have to dial it back, and that basically it felt as if it was written by the Kremlin itself. So that gives you some of the flavor here. On the other side of things, I think many people are expecting J.D. Vance, who's about to speak in 2 hours' time, not to be dialing anything back, but actually expecting something of a wrecking ball speech, and that really says that Europe, you're on your own. These are the conversations that are going on here. There's a lot of sort of tension. Zelensky just walked in a few. The meeting between Zelensky and J.D. Vance was also delayed because the U.S. is still reviewing what they've been hearing from Scott Bessent in terms of the economic program that could be rolled out between Ukraine and the United States. So again, there is just a fire hose of information that these people are trying to metabolize, and we're going to hear from J.D. Vance in about 2 hours, and that's really what everyone's waiting for.
Well, J.D. Vance, and Tyler, I'd love to bring you in. J.D. Vance gave an interview to the Wall Street Journal last night, and he said there are any number of formulations talking about this peace agreement of configurations, but we do care about Ukraine having sovereign independence. Have you seen the administration walk back some of their more conciliatory remarks towards Russia?
Not necessarily, Annmarie, and also important just for context, particularly when we are looking at how J.D. Vance has come into this position. He was one of the staunchest opponents of aid to Ukraine when he was in the Senate. Of course, you'll recall when Congress, about exactly 1 year ago today, was trying to debate additional supplemental security assistance to the country. He was actually the one that ended up leading that charge that kept it stalled until about April, when it ended up passing along with a few other priorities. But interesting to watch here, particularly after we saw President Trump, even in the Oval Office yesterday, suggesting that Russia should be brought back into the G7 to remake it into the G8. Clearly, as we see criticism come out of Washington, that this appears to be a big reversal in U.S. policies, as Annmarie, you have been covering closely with these direct talks between Russia and the United States, and how Ukraine all fits into this. We're going to be watching closely, of course, J.D. Vance's remarks shortly.
Tyler, appreciate the update. We'll catch up with you later once we get those remarks, alongside Ali Crook out of Munich. We've got to get back to that quote from Ursula von der Leyen. The EU will react firmly and immediately against unjustified barriers to free and fair trade. The case that the US is building, and you'll see the conclusion of that case in early April, is that these in Europe are unjustified, that in Europe it's not free. In Europe, it's not fair. In Europe, there are barriers to entry. That's the case the US is building against the Europeans.
And the auto manufacturers are really case in point with the disparity in the increase in the tariff on U.S. autos versus European autos. Where the water gets a bit muddy is the VAT tax and some of these other issues. And that, I think, is going to be some of the hair around this discussion.
Let's get to Jeannette Lowe of Strategas, who joins us now. Jeannette, I think the tough question, what do you say to clients at the moment who ask you, Jeannette, what do you think is going to happen on April 1st? What do you tell them?
So I think the one thing that we've noticed is that it is important to have a difference between tariffs on China and tariffs on the rest of the world. We have noticed that Trump has proposed tariffs several times, and in the beginning first 4 weeks of his administration, but only the tariffs on China, the additional 10%, have actually gone into effect. Everything else seems to be up for negotiation. So we did have Canada and Mexico already negotiate. We had Colombia already negotiate. They're setting up a time frame saying you have basically until April 1st to start making some offers. Obviously, you had Prime Minister Modi coming into Washington yesterday. He came ready to offer some things to Trump to try to fix that reciprocal trade relationship with the U.S. And also the fact that these tariffs were announced while J.D. Vance is in Europe for the Munich Security Conference is also important to try to say, Europe, you need to do something to change the relationship with the United States.
Well, Jeannette, we do have the head of the European Parliament Trade Committee saying that they're willing to lower the tariff when it comes to autos. What else could Europe give the United States in terms of concessions in these negotiations?
So I think definitely the autos has been a thorn in Trump's side for quite some time. So getting that rate down from 10% to closer to 2.5 and matching the U.S. rate would be quite important. Obviously, U.S. LNG has also been really important during the entire Ukraine conflict. I think that Trump is definitely looking for Europe to buy more U.S. LNG, and then also defense. So I think one of the things that plays into Trump talking about lowering U.S. defense spending is also having other countries, including India, including Europe, buy more U.S. defense products and equipment. And so that, I think, also kind of goes into this piece where they're trying to get Europe to pay more for its own defense and be less reliant on the United States, but still purchase more things from the United States.
Jeannette, we've been speculating about some of these proposals for a while. What specifically did we learn yesterday from a proposal that was really light in details?
So I think the point is that this could also be one of the things I thought was very interesting is that Trump did say this might be somewhat of a replacement for his universal tariff that he proposed to do a 10% tariff on all countries. This is a way that they have a new trade law that they're using. It's obviously it's an old trade law that hasn't been used, but that's where they're looking to actually apply this. But it's saying that this is also more of a one-on-one basis, saying that whatever that country's tariff rate on the U.S. is, if they lower it, that is an ability to avoid the tariff or to change other non-tariff barriers that are impeding U.S. trade. So it shows that there is actually a lot of room for negotiation, for changes to avoid these tariffs from going into effect, and also shows that it could be done on a more one-on-one basis rather than a broad universal tariff. I think Trump is really trying to focus on countries with which the U.S. has large trade deficits. Those are countries like China, Mexico, Vietnam, Japan, South Korea, Thailand. Those are really probably where he's going to be focused. India as well, actually. But those are where he's going to be focused on, and then he can kind of move on to other countries. But I think that is kind of what we saw as a little bit of a change there, where you see it could be a little bit less broad in the sense of going after the entire, all imports coming into the United States, but also still shows that there is this room for negotiation.
Just quickly, markets are taking this as an idea that maybe this president doesn't want tariffs for tariff's sake to raise money. Do you think it's fair to discount that at this point?
So I think he does want tariffs for the revenue purposes. Obviously, the Congress does have to pass a large tax bill. Congress is not going to legislate on tariffs, but having that revenue come into the Treasury is certainly something that he can point to say that this is not going to cost as much as it has been perceived, especially when we're looking at the deficit concerns, particularly coming out of the House conservatives. But I do also think that it's not that he wants to necessarily have tariffs in place just to have tariffs in place. He wants changes. He wants other countries to make changes that are more beneficial to the United States, saying repeatedly that he thinks that the U.S. has been treated poorly. And I think that is more ultimately his goal. Jeannette,
appreciate the update. Thank you. Jeannette Lowe there of Strategas. Check out the autos on a stock 600. Higher for 5 consecutive days. Trading right through this. Up next on the programme, Erik Nelson of Wells Fargo on risk appetite with trade tensions on the rise. Live from New York, this is Bloomberg. The all-time high, the intraday record high in the S&P 500, 61.28 yesterday at the close, 61.15, really close to record highs. Equity futures this morning, negative by 0.2% on the S&P. On the Nasdaq 100, we're down by 0.25%. What a couple of days in the bond market. Let's get to it. Let's focus on a 10-year maturity. So on Wednesday, 10-year yields were up by around about 9 basis points. Yesterday, they were down by around about 9 basis points. Even though PPI came in hotter than expected, it was these individual components of PPI. It took a few minutes to figure this out yesterday, Lisa. These individual components that feed into PCE that people took comfort from.
So if you want to know why the bond market rallied yesterday, it was because healthcare costs, airfares, and financial services and insurance inflation came in below expectations. So thank you to those sectors, because that's the reason why a lot of people in the bond market made a lot of money. And the idea here is those feed into the core PCE. This is Morgan Stanley saying that before that PPI came out, they had an expectation of PCE coming in, core PCE, that is the key inflation metric the Fed looks at 0.4%. They downgraded that to 0.3% because of these components. That explains a bond rally that kind of defied our logical understanding on just the headline level.
BMO's Ian Lingan, PPI trumps CPI, to make it very simple and short. Let's check out the euro dollar, 104.67. The ECB this morning, roses are red, violets are blue. Inflation's on track to settle around 2. You sent me that. That was a beautiful card from the European Central Bank.
That was my Valentine to you, is the only thing I thought that maybe you'd enjoy this morning. So they're using Valentine's Day, I think, to push their agenda of inflation to 2%.
Is that wishful thinking?
It's not necessarily wishful thinking, but the time horizon matters. This, I think, is the important question, and I think that Jim Bianco put it really well when he said this is, I believe, the 46th straight reading above 3% when it comes to inflation in the United States. In Europe, will there be the same tolerance to inflation remaining above that 2% for a long time if it's out there?
The euro very close to a 4th consecutive day of strength. On our radar this morning, President Donald Trump ordering his administration to consider reciprocal tariffs on a country-by-country basis. Howard Lutnick, Trump's Commerce Secretary pick, telling reporters all studies should be complete by April 1st, and Trump could act immediately afterwards.
This is just a measure. There was no tariffs put in place, as Jeannette was just saying. The only tariffs that we actually have in place right now is those 10% additional tariffs on Chinese imports. Trump is in full-on negotiating mode. These are tariff threats. These are not actual tariffs, which is why the market was really just shrugged it off. And a lot of this was copy and pasted from what he did in 2016. But it might be working if Trump is accurate when he said he saw reporting, and there was reporting, that Europe is starting to think about lowering their auto tariffs. So all these threats might actually work to get him to where he really wants to go, which is the line I hear constantly, reciprocity.
Jeannette also said that this seems to replace that blanket across-the-board tariff. That seemed to give people comfort as well, because maybe they would end up being lower as just a baseline.
At 1 p.m. he's signing more executive orders, right? So it's another news conference. It's like every day.
I think I was right.
You're going to get more
He's looking for
comments.
things to sign. So
he's producing a show.
Did he sign anything yesterday? Did we get anything signed on tariffs?
Of course we got something signed.
Well, it wasn't an executive order. It was a measure, a directive, an investigation
But it was
to the
signed,
men
was it
behind
not?
him, to the men behind him who are
Did he
not
sign his
confirmed.
autograph?
I think he signed.
Okay.
No,
We're
we
not
just saw that.
confirmed.
He held up the signature.
Yes, that
Did
we
something.
might do something in the future.
We're
that
doing
we'll do.
something.
Yeah, that's a big difference from actually saying like tariffs are going on.
You're correct. But
On
he's-
X, Y, and Z.
The individuals that can look into 301 and 232, Jameson Greer and Howard Lutnick, are not confirmed yet. So he's directing them to do this when they get into the office, which is why you just have to punt this all.
2 months is going to feel like a lifetime, so work with us here. Let's turn to this story. The annual Munich Security Conference kicking off today with the future of Ukraine, the top item on the agenda. Vice President J.D. Vance set to deliver remarks later this morning. When we get them, we'll bring them to you. He's also expected to meet with Ukraine President Volodymyr Zelensky later today.
One thing I think is interesting is J.D. Vance sat down with the Wall Street Journal before he's going to make this speech, and there's one comment that stuck out for me. It seemed like Defense Secretary Pete Hegseth might have went a little bit over his skis in that NATO comment, because we have Vance saying Trump could say, look, we don't want this thing. We might not like this thing, but we're willing to put it back on the table if the Russians aren't being good negotiating partners. So basically saying we might have more threats and warnings that we're willing to put back on the table to deal with Russia, and we're not going to make some big concessions.
I'm really curious to see what the European response is to this J.D. Vance speech, given the fact that in the Wall Street Journal, he said that the European Union is taking away freedom of speech by suppressing the far-right parties, and he really leaned into that. And he said you have to listen to what they're saying with anti-immigration feelings. He also seemed to back Elon Musk, who has taken it a step further, and I think this is important. He hasn't just said free speech. He has actually backed the extreme right group Alternative for Germany. So a real question here of how this will be perceived in Europe.
The Vice President set to turn up the heat a little bit later this morning. Speaking of, JP Morgan CEO Jamie Dimon also turning up the heat, saying his company will scale back spending on diversity programs that he sees as a waste of money, calling some of the initiatives stupid and a little bit more. Dimon also reiterating the bank's commitment to working with Black, Hispanic and LGBTQ communities. The chairman and CEO of JP Morgan said this, and I'll share it with you. According to a recording of the town hall heard by us here at Bloomberg, I saw how we were spending money on some of this stupid beep, and it really pissed me off. I'm just going to cancel them. I don't like wasted money in bureaucracy.
He was talking about bias training. He actually pointed to in specific. This was something he emphasized he would have done with or without some of the directives from President Trump. He said he doesn't like doing things that he thinks are wasteful. He's been talking about this for a while. How much is there just sort of a more openness to discuss this in public at a time where there definitely has been a vibe shift at the top?
Dimon is dogifying JP Morgan. He's like, we spent way too much money on bureaucracy, on things that are not helping our bottom line, and I'm taking it back. Something else he said, another bleep moment. I don't care how many people signed that bleep petition about working from home. He wants everyone back in the office 5 days a week, which I still can't believe in 2025 that is actually a conversation in C-suites.
So I would step away from JP Morgan and just say, for the whole of corporate America, there appears to be a difference between the culture that leadership wants from the CEO and the culture that actually exists within their company. It feels like, beyond JP Morgan, and we can talk about a number of examples of this, that they've lost control of the culture within the company. And we've talked about this a few times around this table, that it just feels like human resources took over the last 5 years. And what the CEOs would like to be seeing happening within their companies is not what was happening.
There is a sense that virtue signaling isn't good enough. They need to actually understand something is working toward achieving a goal. He's saying they're not stepping away from the ultimate goal, but what has been put in place is ineffective and more virtue signaling than, say, achieving that end result.
We'll have plenty of time to talk about this topic because we're going to see more changes across corporate America in the months to come. Let's turn to foreign exchange and the FX market. Erik Nelson of Wells Fargo writing, universal tariffs enacted alongside an expansion in tax cuts would likely keep excess demand elevated, increasing upside inflation risk and necessitating a sharper crowding out of the private sector through higher interest rates and a stronger US dollar. Erik joins us now for more. Erik, good morning. You're not throwing in the towel on that strong dollar story then?
Well, tactically, let's just kind of consider where we are. We've done 112 on euro down to almost parity. Right? So that's a decent move. Positioning we know in the short term is probably extended. So, okay, we can see a bit of a tactical reversal higher. Are we going to get back to 108, 109? Probably not. Can we see 106, 107? Maybe. But I think, all of this back and forth on reciprocal tariffs, 25, I think at the end of the day, it's a lot of noise. And so markets are saying, all right, we need to see something actually happen here, right, to hold on these long dollar positions. So maybe there's a little bit of sort of tariff fatigue and long dollar fatigue in the short term. But down the road, tariffs are probably coming. They're probably coming in particular on China. Auto tariffs are probably coming. That one seems like a pretty low-hanging fruit. And this stuff is going to be really negative for global growth and probably negative for Europe in particular. So I think euro can see a retest of some of the recent lows in the next few months. But, I mean, to really see a significant, 95 cents or something really lower, you got to see universal tariffs. And that could still happen, but we need to see it actually put into practice as opposed to talked about.
Against that case, some people say if there's peace between Ukraine and Russia, that's a game changer. Suddenly you end up with euro strength that we hadn't been expecting in the 110s to 115s. Do you reject that?
I do. Yeah, I don't really see the sustained bull case for peace, or rather for euro based on peace between Russia and Ukraine. I guess the one exception, maybe, is if you actually see Nord Stream turn back on and natural gas start flowing back from Russia to the EU. I think it's a long shot, but it is technically possible. Outside of that, you're not going to see a substantial decline in natural gas prices over any sort of sustained time frame without that. And I think that's really the only thing that really matters in terms of euro strength coming from that. I mean, the other issue here to keep in mind is these peace talks, Europe's not, as far as I can tell, not really involved. That's not great for sort of long-term security considerations in the region.
At the same time, people say it might actually push the European Union to spend a significantly higher proportion of their overall GDP on defense, on investing in some of these other projects, which could actually spur the growth that has been so lackluster, especially at a time where we just got a GDP print out of Europe that exceeded expectations. Why do you push back against that idea? Why are you laughing?
I mean, what? By 10 basis points?
Look, it's something. We said that
Instead
it was
of 0, it was 0.1.
Okay, look.
Is that what I saw this morning?
Yes,
I'm pretty sure it was.
Saw.
Okay, you're playing it up big time.
To the UK. But this is the thing. But we said that it was a low bar. How low is the bar?
I'm with you. We closed out 24 and we said how little needs to go right in Europe to generate outside gains.
Exactly.
I'm with you. Carry on, please. It's just funny how you dropped that in there. Because if I woke up this morning and just tuned in and heard that, I'm thinking, oh, Europe's back. 3% GDP
Eric,
growth. Let's go.
This is ridiculous.
So I think you're absolutely right. The bar has generally been low for European data surprises. I'll acknowledge that. I'll say on the military spending thing, what concerns me is this probably will come in the 2028 sort of European budget negotiations. 2028's a long way away. What about Germany's election? Okay, maybe you get some modest debt brake reform. It's probably not coming until later this year. It's probably a 2026 story in terms of the economic impact. And even if you get to the EU budget negotiations, how are we going to allocate this money, right? Whose national defense sort of contracting are we going to be choosing? There's lots of considerations here. It's going to be a bit messy, I think. Long term, I see it. But over a tradable horizon, I'm not sure it's the reason to get long euro.
But when you look at reports and you talk to people, they say that defense spending is one of those levers Europe might pull as a concession to Trump on tariffs, because he has been hammering them about higher defense budgets of those countries that are NATO. Couldn't you see that happening actually this year or 2026?
I could see commitments. So I could see NATO's already talking about raising its defense spending target as a percentage of GDP. I'm sure the EU will say the right things to appease Mr. Trump as part of a broader negotiation package, right? Maybe buying more or finding ways to convince Mr. Trump that they will be buying more oil and gas. We know they can't actually literally do it themselves. We talked earlier about the sort of show that's being put on. I think Europe knows how to, from 2018, how to play that game. Is it going to manifest in actual significant spending increases? I'm less convinced. And the other point I'd also make is kind of the multiplier, so that the economic feed through and sort of knock-on positive impact from defense spending, especially on equipment, not that high.
When it comes to something Jonathan mentioned, inflation in the United States early on in the program, this idea from Michael Hartnett at Bank of America that price pressures are a blessing in disguise. Do you think price pressures could be a check and balance on Trump's impulses when it comes to tariffs?
I'm less convinced, put it that way. I think to the extent you get real pressure on the bond market, then maybe that's something of a break on spending plans or whatever it is that he perceives to be driving the bond market reaction. I think at the end of the day, the equity market may be the best break on those plans. And so far, because we haven't had significant action, there's not a lot of reason for him to stop.
Eric, it's good to see you, as always. Erik Nelson there of Wells Fargo. People are so sceptical about the tariff effort. It's kind of amazing. Equity's very close to all-time highs stateside. We've had this big rally over in Europe. You tell people that tariffs might come on April 1, they'll say, we'll see. And if they get those tariffs, they'll say, let's see if they stick. A lot of people don't believe in this push.
And part of the reason why is because we don't understand the framework that it's operating in. We don't understand what the goals are. We don't understand what the deliverables are. We know that tariffs are the most beautiful word in the English dictionary. We know that this was a priority for the president. But beyond that, what do we know about what he wants this world to look like in 2 years' time? We have some ideas. It's not a total blank slate.
Sure.
But on a tradable basis, it's hard.
One thing we do know is how we're priced relative to the threat. Right now, equities are priced pretty nicely. So if you think where there's scope for surprise, there's scope for surprise that they do go on and they stick.
Well, I keep going back to what Tom Narayan said yesterday, which is if you have negative infinity out here and then you have, plus 10, well, if you average it out, you get negative infinity if you believe that negative infinity was an actual number. But if you don't, then you have something that looks decent. So why factor in negative infinity?
Equity futures right now, just down a little bit. Very, very close to all-time highs. We're negative by 0.2%. Let's get you an update on stories elsewhere with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Speaking at the Munich Security Conference, Ukraine's President Zelensky says that his recent phone call with President Trump was positive. He said his country is ready to discuss any means necessary to stop Russia's aggression, maintaining that President Putin doesn't want peace. Zelensky also reiterated that continued support from NATO is the cheapest way to protect Ukraine. U.S. Transportation Secretary Sean Duffy said that he asked Boeing CEO to provide a full accounting of the plane maker's actions to improve quality and safety. In a post on X, Duffy said that he plans to visit Boeing himself to, quote, ensure its planes meet the highest safety standard. Boeing hasn't responded yet to the post. Apple will bring its AI features to China by the middle of the year, launching as early as May. Sources telling us that the iPhone maker has teams in both countries adapting its Apple Intelligence platform for the country. In China, Apple will use its own AI models with Alibaba software as a layer to censor materials that the government objects to. Apple, though, does still face regulatory hurdles. And that's your brief. John.
Danny, thank you. Appreciate it. More from Danny in about 30 minutes' time. Up next on the programme, pushing for peace in Ukraine.
Russia has gotten themselves into something that I think they wish they didn't. If I were president, it would not have happened. Absolutely would not have happened. I think that when you look at Ukraine and when you look at the mess that they're in, it's got to be ended and it's got to be stopped.
What do those comments mean for the energy market? We'll catch up with Daan Struyven of Goldman Sachs in just a moment. From New York City, you're watching Bloomberg TV. Equity futures right now on the S&P negative by 0.2%. Lots of economic data through the week. PPI, CPI later on this morning. One to watch at 8:30 Eastern Time. US retail sales just around the corner. And the surveillance this morning pushing for peace in Ukraine.
Russia has gotten themselves into something that I think they wish they didn't. If I were president, it would not have happened. Absolutely would not have happened. I think that when you look at Ukraine and when you look at the mess that they're in, it's got to be ended and it's got to be stopped. But as far as the negotiation, it's too early to say what's going to happen. Maybe Russia will give up a lot, maybe they won't, and it's all dependent on what is going to happen. The negotiation really hasn't started.
So here's the latest this morning. Energy markets watching for progress on peace talks in Ukraine. The Vice President, J.D. Vance, expected to speak at the Munich Security Conference later on this morning. Vance telling the Wall Street Journal the U.S. would hit Moscow with sanctions and military action if Ukraine doesn't get long-term independence. Daan Struyven of Goldman Sachs joins us now for more. Dan, just hearing from the Treasury Secretary as well, who's speaking to a U.S. broadcaster just moments ago, saying that if Trump directs, we will further sanction Russian energy. So it's kind of difficult to work out what's going to happen here. Do I price in peace or price in escalation? What are you telling clients?
Yeah, so our base case is that Russian oil and natural gas volumes to Europe and the rest of the world are not going to change significantly as a result of any change in sanctions. If we were to see a peace deal, we think it's quite likely that part of the peace deal would involve a pickup in natural gas flows from Russia to Europe because it makes sense for all the parties. It makes sense for Russia from a revenue perspective. Ukraine would likely benefit from transit fees, and Europe would benefit from significantly lower gas prices. In fact, we estimate that if you were to see a return in Russian gas flows through Ukraine to pre-war levels, and so this would not involve flows through Germany or Poland, that alone would be enough to reduce TTF European natural gas prices by up to 56%. And in a sense, the European energy crisis would end now. Our base case is that it ends in 26 and 27 with the arrival of all those LNG cargoes coming from Qatar and the US. But if we were to see a normalization in gas flows via Ukraine from Russia to Europe, we would expect a large drop in European natural gas prices with up to 0.5% of upside to European GDP.
Okay, well, what if this goes the other way and this administration has to escalate, maybe with the end goal of de-escalation? What happens if they outright sanction Russian gas and oil, not doing what the Biden administration did, which was have the price cap?
Yeah, so in the natural gas market, Russian flows are down 88% since the war. So if you were to see a tightening in sanctions, it would cause upside to oil prices, but limited impact on the natural gas market. So if you, for instance, were to see a 1 million barrels per day drop in oil supply from Russia, and also a 1 million barrels per day drop in oil supply from Iran, where the government has said that we're going to return to maximum pressure, we estimate that Brent would rally to just above $90 per barrel in terms of Brent terms. Over time, however, our assumption is that Saudi Arabia and the UAE, with a lot of spare capacity, would offset that tightening shock. But there's clearly some uncertainty about the reaction function of OPEC as well in this highly uncertain geopolitical context.
But at this moment right now, the administration is basically saying we can go either way. So what do you price for?
So I think that the oil market is really pricing the risks of higher supply and lower prices. We think that in the short term, the risks to oil prices, or base case is that you have Brent at $78 per barrel this year. But we think in the short term, the risks are very much skewed to the upside, especially relative to market pricing. We think that oil prices are now about $8 per barrel undervalued. If you look at global commercial total inventories, they are down to May 2022 levels. They have dropped a lot, in part because of improvements in OPEC compliance. So the market is really not pricing any significant upside to oil prices. And so we think the risk to oil prices in the short term are skewed to the upside. And then in the gas market is not really pricing downside risk to prices, very different from bond markets and equity markets, where we have seen big rallies in assets that would benefit from a peace deal.
So we could potentially see some sort of sell-off in a good way for natural gas, at least for the users. I want to just lean into this idea of the upside risk in oil markets. How much is that derived from what you said, which is that supplies have actually been cut off due to compliance with OPEC's directives versus demand really picking up?
So we think that the main reason that we have seen draws in global commercial inventories is OPEC cuts. Saudi Arabia is producing only 9 million barrels per day of crude. That was above 11 in 2022. Demand has been fine, growing about at 1 million barrels per day, the long-term trend, with disappointments in places like China, but strength in places like the US, India, and sort of EM Asia ex-China.
Prospect of energy prices coming down, gold still rallying. What gives? What's that about?
Yeah, so gold continues to be our favorite long-run structural commodity, both because in the base case, we expect a lot of additional support from structurally higher central bank purchases. And to tie it back to what happened in Russia in 2022, we think EM central bank managers, reserve managers, have learned that treasuries are not necessarily completely risk-free in the long run. And even if you were to see a peace deal, I think this was a watershed moment. I think we crossed the Rubicon, and we think central banks in emerging markets will continue to buy a lot of gold. So that's the exciting structural long-run bull story. But the beauty about gold is it's a hedge against arguably the three most important risks to global markets. Tariff escalation, concerns about rises in U.S. debt. We're not on a sustainable trajectory here. And third, some uncertainty about the leadership at the Fed in the future. Base case is that some inflation expectations will remain very well anchored. But if you're worried about that, gold is your go-to asset.
Dan, it's good to see you. Dan Struyven there of Goldman Sachs. All-time highs on gold this morning.
There was a Wall Street Journal article about how bankers in London were taking gold bars on commercial airlines and bringing them to New York. I love this story. I want to know what the suitcases look like. Do they put them through security? Do they lift them? Do they have to do lift weights ahead of time?
So it's just a nondescript Rimowa, just sort of thrown out there.
A nondescript
no one knows.
Rimowa.
You're looking for that guy who's like really like pulling that thing off the belt.
He's like.
Up next on the programme, we'll catch up with Dan Skelly of Morgan Stanley, Henrietta Treyz of Veda Partners, Heidi Crebo-Rediker of the Council on Foreign Relations, and Sarah Bianchi of Evercore.
People are very quick to sell. The market bounces back. Earnings are going to grow by 10% this year.
I think you're going to get a correction in the riskier part of the equity market.
The idea that baseline volatility is higher just because Trump is in place, I don't think is correct.
Because companies are delivering earnings, that's a solid foundation for the stock market.
The attitude toward bringing more capital into the market is just much more positive.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning, the second hour of Bloomberg Surveillance starts right now with equity futures very, very close to all-time highs on the S&P 500. We pulled back just a touch. We're down 1/10%. On the Nasdaq 100, we're down by 0.2%. There is a very big morning once again coming up. It's wearing thin, I know, but it's another one. At 8:30 Eastern Time, we get retail sales in America. That's the final big data point of the week. We should hear at some point this morning from the Vice President J.D. Vance to look out for that. Then later on this afternoon, this is becoming a daily event. Executive orders with the President of the United States and hopefully more comments.
Well, more comments particularly about tariffs to give some more clarity about what we could see, because yesterday it was the big one and we got it. Something was signed, but it was some investigation potentially into what could come down the pike. The takeaway was it seemed to, at least for the moment, remove the chance of a blanket across the board tariff and go more for negotiations specifically with each company. The market took that as a very good sign.
I'm always looking for signal in the stock market, and I'm getting it from Europe right now on the stock 600. The fact that autos on the stock 600 are up for 5 consecutive days in Europe, I think speaks to how the market feels about the tariff headlines right now. They're focused much more on what the president is not doing, actually putting tariffs on Europe and elsewhere, and they're focused not on what he's saying. And if you focused on what the president said yesterday, you'd walk away with some stunning headlines, particularly on geopolitics. The headlines around geopolitics, allow me to share some of them with you, just to go through them. I'd love to have Putin back in a G7. Russia should be sitting at the table. We'll meet with China and Russia and the military on spending. I want to cut the military budget in half. I want to reduce nuclear weapons. That should be front page news. And then I went through the front page of most of the newspapers in America. Barely featured.
That's because he says a lot of what he's thinking, like he's a regular citizen and sometimes doesn't realize that he's sitting behind the Resolute desk and he's speaking like the President of the United States. Jonathan, you've said this before, but it's why then you see the Wall Street Journal editorial board come out with a piece this morning that says, quote, peace through weakness in Ukraine. A lot of skeptics are saying he is showing his hand on what he's willing to basically give Putin as concessions for coming to the table. Now, what I think was interesting, J.D. Vance did sort of seem to put more back on the table and say they want a sovereign Ukraine, and maybe things like NATO would come back on the table, more of a maximalist approach. But Trump was saying that he's even so willing to have him come back into the G8. That is going to send shockwaves through Europe, which you're going to see throughout the weekend at the Munich Security Conference.
This is an exercise in being a Trump whisperer. This market is becoming a Trump whisperer at a time when a lot of things that he has said could potentially have been incredibly disruptive. I think it was this week. Was it this week? Was it last month? Was it 2 years ago that he was talking about treasuries potentially not having to pay them all back, essentially, and then that had to be walked back? And that
was earlier this week.
It was over the weekend on the way to the Super Bowl.
Anyway, that's the reason why people are focused on what wasn't said. And in Europe, you also had that massive upside surprise in the GDP, and that also is giving some real encouragement.
He says so much. It's like a fire hose. So you have to decipher what is important and what actually will become reality of policy. Yesterday, what we saw is a lot of bark, no bite. Not a single tariff was put in place to this day, even though every day has been a big tariff day. To this day, the only tariffs that are in place are the 10% on China.
From a market's perspective, purely from a market's perspective, this is what it's all about. This is the most fascinating time in financial markets in the last 5 years. The last administration was an absolute snooze. You barely ever heard from the president in the last 12, 18 months. We're hearing from him every day. They're trying to push a monster realignment across several dimensions, and financial markets have got to reprice that story every other day.
This, to me, is really the key point, and you absolutely hammered it, which is this is a president that wants a complete realignment of trading agreements that had been agreed to under the WTO, which he has talked about possibly leaving. There is a real question of what the post-Donald Trump economic order looks like, and how does this market respond to something that they can't quite envision. It will look different, though, and I think that is relevant.
Let's get into some of it this hour. Joining us, Dan Skelly of Morgan Stanley, with stocks very close to all-time highs. We'll catch up with Henrietta Treyz of Veda Partners as Trump's reciprocal tariffs are delayed, and we'll speak to Heidi Crebo-Rediker of International Capital Strategies as the Munich Security Conference begins. We begin in Washington as President Donald Trump orders his administration to consider reciprocal tariffs that could come as soon as April. Bloomberg's Tyler Kendall joins us now for more. Now, Tyler, there's a sigh of relief on Wall Street, I've got to tell you, because we didn't get the tariffs. What's the message coming from Washington, from the White House?
Right. Well, John, this is really just the first step ahead of potential tariffs, and it's going to be a huge undertaking for the Trump administration. We know that Commerce and the USTR are now tasked with studying about 200 trade relations ahead of putting together these tariff country-by-country calculations. And it's going to take into account both individual countries' tariff rates and schedules, but also what the White House is calling non-tariff barriers. Think subsidies, value tax, even IP protections are all going to be folded into this as they try to put forward exactly what tariff rates could come when we were looking at each of these countries individual. And you mentioned that April 1st deadline. We heard that from Howard Lutnick yesterday, who actually, also important to note, just yesterday passed a key procedural hurdle in the Senate to tee up his confirmation, but he is not Commerce Secretary quite yet, but did address reporters in the Oval Office saying that April 1st will be the timeline. And then from there, they will look to see if they are off to the races, depending on how these countries come to the negotiating table. And I would just quickly mention, John, that there does seem to be some leeway here, right? President Trump's senior counselor on trade and manufacturing, Peter Navarro, was on Balance of Power yesterday, and he dodged questions on whether or not the end goal here is either zero tariffs or equal tariffs, which opens up this possibility that there very likely needs to be many more negotiations underway to get to their final goal.
Hey, Tyler, appreciate it. Tyler Kendall with the latest in the nation's capital. Joining us now, Daan Skelly of Morgan Stanley. Dan, welcome to the programme, sir. Your outlooks for 25, you and the team reflect this Goldilocks view of the world. How much of a challenge to that view is coming from potential policy changes?
So, good morning, John. We've been thinking about policy changes for a long time. And the mantra that we've been working with is fast announcements, slow implementation. So not much has changed there, frankly, and you're seeing in Washington a lot of the theater in terms of how slowly things could actually play out. But more broadly, Jonathan, we're seeing rotation in the equity market that we expected based on a host of fundamental and macro factors that really transcend fiscal policy.
Like what? What are the macro factors that you think are much more important to the market right now than what the Fed does or even what Donald Trump does?
Good morning, Lisa. Great to see you as well. Happy Friday. So a host of things. First, after a lot of volatility and debate around the path of the Fed last year, proactive versus reactive Fed, we've got the 95 soft landing proactive Fed scenario. The Fed has finally sent the engraved invitation to the market. And we recognize people are still debating one cut or two cuts, but we think that's really marginal in terms of risk factors. Secondly, we're seeing earnings broadening out. We're about 80% through 4Q earnings reporting season, and you're seeing almost every sector report positive earnings growth. And it is a very different spectrum of results versus what we saw with the Mag 7 dominance 2 years ago. Last but not least, the DeepSeek news has exacerbated the overhang or the specter of what is the ROI on AI spend. And so you're seeing that kind of spending Mag 7 enabler cohort put in the penalty box for the moment.
At this point, Dan, all of those things sound like a really good story. And then someone comes in and says, but what if tariffs totally upend the auto sector? And what if tariffs add to the inflation story and prevent the Fed from being able to cut and actually stymie some of the ability for the broadening out to continue, particularly in some of the smaller stocks? How do you dampen those fears of that type of tail risk at a time where we have a lot of noise coming from Washington, D.C.?
Yeah, it's extremely well said, and it's all out there, frankly. And you stay diversified, right? We've been saying to folks that you don't want to chase some of the extreme leadership of the last 2 years. You want to think more broadly vis-a-vis other asset class selection and real assets, other income sources of income. If we get that in sticky inflation or even higher inflation scenario, which would dampen traditional fixed income. So we've been advising clients about these risks, Lisa, for many months now. And I would just lastly say, in terms of that risk factor, look, it may cap the upside this year. The S&P is trading at 21 times. But at the same time, we don't see a bear market or a huge downside scenario because we don't see recession. We don't see an earnings recession, clearly. And we don't see the Fed hiking. By the way, Lisa, all three of those variables were in play in 2022 when you did have a 20% drawdown.
Dan, though, you do say in your note that there are key variables that are challenging the force of American exceptionalism. So if you don't want to invest in America, potentially if exceptionalism's on its way out, where else do you go?
Well, let me clarify, Annmarie. So first, American exceptionalism was not consensus 2 years ago. We had to disprove a recession. We had to get the benign Fed scenario, proactive, 95, and we had to get through the election. So a lot has happened on the way to the 70% rally as of the last 2 years. All we're saying within the U.S. market this year is be more diversified and lean into some of the broadening out that's going on vis-a-vis industrials, software, AI adopters, financials, banks, et cetera. Outside of the U.S., we've been thinking more about Japan from a bottom-up standpoint, and that, as you know, has been a volatile market as of the last 6 or 7 months after being a really strong structural trend. We still see really profound corporate reform and company-specific catalysts there, as well as opportunities for idiosyncratic opportunity. So Japan remains one of our favorite ideas internationally, Annmarie.
International is flying. Dan is going to catch up and get an update on your thoughts. Dan Skelly there of Morgan Stanley. Mohammed Al-Erin in the Financial Times this morning on mounting risks to U.S. exceptionalism. Michael Hartnett of Bank of America with this note. Really great note from him and the team this morning. Geopolitical conflict is positive for U.S. stocks. Geopolitical peace is positive for international. We are long international in 25. No one positioned for the rest of the world equity outperformance. He goes on to say this, that the squeeze rally in peace trades is to be tested by German election and will end once a peace deal is imminent. So we've got this squeeze right now. Real outperformance on the DAX so far.
And if you take a look at what Michael Hartnett likes, he likes U.S. bonds. He doesn't like equities because he thinks that they're too crowded, and he likes Europe. So this is sort of the antithetical view of a lot of people who come on this program who don't like bonds, like U.S. stocks, and don't like the rest of the world. You can make an argument for either, and I think that that is compelling to me.
What's the old saying? Price shapes narrative. Lots changed in 2 months, right? On that front, that's for sure.
Well, and you feel it every day with the flipping and the flopping of the narrative. I mean, 2 days ago we were worried about inflation. Now we're worried about the loss of U.S. exceptionalism. Pick your narrative.
Futures right now, negative by about 1/10%. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Vice President J.D. Vance telling the Wall Street Journal that the U.S. would hit Moscow with sanctions and military action if Putin doesn't agree to a long-term independence for Ukraine. The vice president's remarks comes ahead of his expected meeting with Ukraine's President Zelensky in Munich today. President Trump and Elon Musk are accelerating their purge of the federal bureaucracy. Thousands of probationary employees and several government agencies have reportedly been laid off. The Office of Personnel Management met with federal agencies and told them to lay off most of their probationary workers. Robert F. Kennedy Jr. was sworn in as President Trump's head of Health and Human Services. The one-time presidential hopeful was sworn in after winning Senate approval 52-48, mostly along party lines. Former Senate Majority Leader Mitch McConnell was the only Republican to vote against him. And that's your brief. John.
Hey, Danny, thank you. More from Danny in about 30 minutes. Up next on the program, leveling the playing field.
Whatever another country charges, we're charging them. So it's called reciprocal, which I think is a very fair way. So we're just going to do it the easy way, and we're just going to say whatever you charge, we charge.
That conversation up next with Henrietta Treyz of Veda Partners, live from New York City this morning. Good morning. Plenty of drama in the last 24 hours, just not in the stock market. Equity futures down by about 0.1%. In the bond market, yields just about unchanged. The 10-year, 453.27. It is Valentine's Day. This is for the gentlemen out there. If you're waking up and you haven't done it yet, do it. It's a long weekend stateside. Don't ruin it for yourself. Get out there, buy a card, buy the flowers.
Chocolate's better. I thought you were going to say, just take a snapshot of the screen and say, look, there was red for you. Happy Valentine's Day.
A nice PSA for you. Happy Valentine's Day to all of you. All right?
That was lovely. That was
Good.
beautiful. You know,
Good.
I think it's random act of kindness throughout the year. I think that matters
Here we go.
more.
Good.
I think that,
Okay.
you don't have to lean into
John's not taking
the
any
Hallmark.
chances.
I know. Maybe you want the insurance policy.
Don't take that risk. Under surveillance this morning, leveling the playing field.
We are right now a reciprocal nation. We are going to, if it's India or if it's somebody else with low tariffs, we're going to have the same. We're going to have whatever India charges, we're charging them. Whatever another country charges, we're charging them. So it's called reciprocal, which I think is a very fair way. So we're just going to do it the easy way, and we're just going to say whatever you charge, we charge.
So here's the latest. President Trump ordering reciprocal tariffs on U.S. trading partners on a country-by-country basis. The tariff set to launch as soon as April 1st, opening the door for negotiations. Henrietta Treyz of Veda Partners writing, tariff revenue will be an essential revenue stream, and investors should take the president both seriously and literally where they are concerned. Henrietta joins us now for more. Henrietta, welcome to the programme. I want to get into that point. Lisa's been talking about this all week. What are the objectives? What are the objectives, and how easy is it to avoid some of this? Because the market's taking a clear view, I think, that some of this might be avoidable. What's your message this morning?
Well, first of all, happy Valentine's Day. Great to be here. I would say, generally what we are looking at in Congress and the way that I approach tariffs is through the lens of taxes and deficits. So the tax bill that House Republicans unveiled last week is a $4.5 trillion package, $3.3 trillion of which is deficit financed. The way that you get massive deficit hawks like Chip Roy and Ralph Norman to be on board with this package is to promise them revenue from the White House via tariffs. They are incorporating tariff revenue into their tax package. So as they are writing this bill, which I suspect will take months from now to actually hammer out the details, text is due March 27th, but that's sort of a squishy number. The president needs to continue making it clear to these members that there will be revenue from tariffs, so that they don't end up focusing on the massive cuts that will have to come to Medicaid in order to get this bill through. There's $880 billion in this tax package associated with Medicaid, and cutting from there. And that is a basket of revenue that they're going to have a very hard time getting through the House and the Senate. So the tariff revenue is essential as a process of getting this tax bill passed.
Okay, Henrietta, but at the same time, the president says he wants reciprocity, eye for an eye, tariff for a tariff. And so far, the only tariffs we have are the 10% on China. At this moment, it seems like he's in negotiating mode, not revenue-raising mode.
Yep, exactly. And so a lot of this is to do with, needing to staff up. He does not have a USTR yet. Howard Lutnick is not there yet. They're talking about April 1st in the America First trade agenda, the policy that he released on Inauguration Day. They discuss how all of these items, from the Section 301 investigation into China to the 232 tariffs, are going to be reviewed, and the review is due April 1st. Commerce Secretary Lutnick confirmed that yesterday. The tariffs are going to be ready to go on April 2nd. I think there's a period of time where the Congressional Budget Office will also have to review them. There's delays here, but what is coming is a need for revenue, and I think at minimum investors should take this as something that they expect for months, at least the threat, if not the actual imposition.
How important is it for clients that both of these two actions on both sides of Pennsylvania Avenue happen at the same time? Tariffs when you at the same time get the tax cuts.
It's exactly the playbook from 2017. It's a great point that you bring up. One of the things that we talk about a lot is how the first round of tariffs were inflationary, but we often forget that we cut the corporate tax rate by 14 points, not percent, 14 points, just months before that bill, the tariffs started coming into effect. They rely on a whole of government economic policy. And by the way, this is going to come with subsidization of domestic farmers and other domestic industries. They're talking about subsidizing the pharmaceutical industry, the chipbuilding industry, the shipbuilding industry. I mean, there is money that is going to flow out the door while these tariffs go on, just to try to minimize the very negative response that we're going to get from the prices being paid at the border, but also in terms of retaliation from other nations. Given
you say tariffs are a must for reconciliation, where are we right now in the reconciliation process?
Oh, man. Well, as I say to clients, the fat lady has not sung yet. There is still a pretty serious disparity between the House and the Senate. So the Senate has a $342 billion package that's just associated with immigration and military spend. Senator Graham wants to get that bill out the door. The Senate might even vote on it as a whole chamber next week while the House is on recess. Meanwhile, last night, the House passed a very massive bill that is all of those things on military immigration, plus a $4.5 trillion tax bill. The real issue is that $4.5 trillion is not going to cut it. We need more money than that to do any of the things President Trump promised on the campaign trail, and to give anything to the SALT caucus, and to make sure that there's not those $880 billion in cuts to Medicaid. So there's an incredibly long way to go, and the two chambers are at war with one another right now, just trying to get something through while the president promises tariffs.
You mentioned Medicaid twice. Do you actually think that it's on the chopping block?
It is on the chopping block. $880 billion from the Energy and Commerce Committee means that Medicaid is on the chopping block. It is the single largest revenue raiser in the entire bill.
Which is something that is going to be a very interesting result for a lot of people to digest. I want to bring up something we've talked about significantly over the past couple hours. Bank of America's Michael Hartnett came out and said, actually, it's a blessing in disguise that we have inflation that seems to be ticking upward, because it'll tie the hands of this president for how far he can go with tariffs. And I would argue that actually does apply somewhat to the budget as well, given what your reaction you see in the bond market. Do you agree?
I'd have to respectfully disagree. One of the things that I sort of stake my name to is this expectation that the House and Senate Republican conference would have the appetite for $2.5 trillion worth of deficit increases, which, by the way, is over $500 billion larger than anything we've ever passed before. And I was wrong. The number came in at $3.3 trillion in deficit finance spending. They are assuming that the extension of existing tax rates, not new cuts, extension of existing tax rates is going to generate over $2.6 trillion in economic growth. So they are relying on math that the Joint Committee on Taxation will not agree with, the Congressional Budget Office will not agree with, and they are assuming that there will be massive economic growth from the deficits that they incur. So there is no restraint here. They have a larger appetite for deficit increases than I anticipated by over $1 trillion than what has ever been done before. So no, I don't think they are bound by inflation at all.
Henrietta, appreciate your insight and your opinion on the matter as well. Henrietta Treyz there of Veda Partners on the latest trade effort. I can tell you what the market's thinking. I won't have to give you my opinion. The market is thinking this is avoidable. It won't be as bad as you think it will be. Autos in Europe, as we mentioned at the top of the hour, up every single day so far this week. In fact, they're up by more than 7% on the week so far. And this was meant to be the week of reciprocal tariffs. There are some people out there who believe that this won't be as bad, but also that maybe tariffs go the other way. They might come down. And the president alluded to that on European autos just yesterday.
If you take this president at his word, the latest word, I mean, there are a lot of words, but the latest word would signal that you could get some sort of negotiation where if they lower their tariffs, we won't raise our tariffs. And that could actually lead to a more free trade scenario. We were talking yesterday with Adam Posen of the Peterson Institute, and he said that would be fine. If it's a reordering of just the trade partners, great, as long as that continues to allow some sort of trade paradigm that doesn't put up the barriers.
This is what Trump had to say about the EU. I believe I heard that the EU today or yesterday lowered the tariff for their cars to 2.5% because that's what we charge, and they lowered it from 10%. He's basically saying this is already a huge win. And then you go back to some of the reporting from the Financial Times a week ago saying this is what the European Union is discussing. They would have to go to the WTO. This may cause some problems. That means for China, it'll be the same tariff. But they are looking at lowering their threshold when it comes to autos. And this is one of the biggest grievances this man has when it comes to the European Union and Germany specifically.
6 weeks is a long time in this market, and you've got to wait 6 weeks, essentially, to find out what happens with tariffs on April 1. And in the meantime, the squeeze continues. European equities higher, close to all-time highs. In the equity market stateside, too, we're very, very close to all-time highs.
People are looking at the fundamentals, as Dan Skelly was talking about, and they are pretty positive. And if you take a look at what's going on with healthcare, airfares, and a couple of insurance premia, you can actually see that you do get some disinflation.
The Fed might not have to hike, you know?
Correct.
We'll take that. Up next on the programme, Heidi Crebo-Rediker of International Capital Strategies as the Munich Security Conference begins. From New York, this is Bloomberg. On the schedule this morning, 8:30 Eastern Time, US retail sales about 60 minutes from now. Then later on this afternoon at about 1 p.m., you'll hear from the President of the United States, set to sign some more executive orders, somewhere in between. At any point through the next few hours or so, we could hear from the Vice President, J.D. Vance, at the Munich Security Conference. And when we hear those comments, we're going to bring that address to you right here live on Bloomberg TV. Equity futures at the moment on the S&P, negative by 0.1%. On the Nasdaq 100, we're down by close to 2. Your opening bell is 2 hours away. And with your morning movers is Danny Berger. Hey, Danny.
Hey, John, some earnings to get through for you. Airbnb, we are off to the races this morning, up more than 14.33%. Not only was the holiday season very strong for them, they said the current quarter that we're in, that strength is continuing. It's showing some stability. After the entirety of the travel sector, we wondered if the post-pandemic boom had really petered out, whether things were starting to look dire. This suggests that perhaps they are not. We also had earnings from Applied Materials on the other side of things. Sure, demand for their AI making equipment was really strong. The issue was export controls. 30% of their business is in China. They say they're having a hard time selling to them, given the administration and the policies we've seen coming out of Biden and now possibly Trump. So those shares down 4.5%. Wrapping things up with Intel, I just want to go through the numbers on this. Up another 2% this morning. Should it continue this throughout the day, it will be the biggest weekly rally for Intel since 1982, up 26% this week. It all started J.D. Vance at a Paris AI summit saying that he wants to build the most advanced chips in the U.S. Analysts said maybe there's a deal in the works with Intel and TSMC, but John, some important context for that. Intel did lose more than half of its value last year.
Danny, appreciate it. Thanks for the update. The latest from Danny Berger and some of the movers. Intel absolutely flying. And just keeping tab of what's happening with Meta. Meta, 19 consecutive days of gains. That's still going. We're on for day 20.
They said the right stuff when it came to AI and how they were going to be deploying it, and they delivered the earnings to prove that they can monetize some of this. With Intel, fascinating how a lot of people left it for dead because they believed that Donald Trump wouldn't make it the same national champion that Biden tried to. Seems like maybe they're going to lean into some of those production efforts as well.
Huge run for a couple of those tech stocks stateside. On our radar this morning, some top stories for you. Hamas saying it will free Israeli hostages as scheduled tomorrow. The terrorist group backing down from its previous threat of an indefinite delay that had cast doubts on the durability of the initial 6-week Gaza ceasefire.
So Trump said that all hell would break loose if this didn't happen by noon on Saturday. Hamas is saying they will release those hostages. At least 3 Israelis are still being held by Hamas, and they will be released in the next round. What's a little bit more interesting right now is what happens to the phase 2 of this ceasefire agreement, because in the midst of all this, Trump has come out and said he wants to redevelop Gaza. Now, that has infuriated, to be polite, a lot of Arab leaders. But Trump is putting it on the Egyptians and the Jordanians to try to help figure it out. And Egypt is saying that they are working on a plan.
When we get those comments from the Vice President, J.D. Vance, at the Munich Security Conference a little bit later on this morning, will we get any comments on the Middle East? Because the focus has really shifted back towards Ukraine.
Well, I think there will be one comment on the Middle East, and it's the fact that Saudi Arabia is going to be the place where Trump and Putin will meet. Trump has said this. And then yesterday, Trump made a comment about how next week, he said, there's a meeting in Saudi Arabia, not with myself or President Putin, but with top officials. I've been told that this meeting next week is the first set of meetings to prepare for that summit. And one individual I spoke to a few sources on this, said it could be at the National Security Advisor level. So we'll wait to see who exactly they send.
Interesting. Also on our radar this morning, we mentioned some tech names. Let's get to this one. Apple is planning to launch its AI features in China by mid-year. Sources telling us here at Bloomberg, the company is aiming for a May launch date. The rollout of Apple Intelligence in China facing regulatory and tech hurdles. It's a high-pressure situation for the company, of course, which continues to see sales decline in the Chinese market.
This, to me, is one of the most fascinating stories, especially in light of the partnership that they've been forming with Alibaba to roll out some of this technology. This has forced Apple to make much closer partnerships with the tech giants and the tech champions in China in order to do this in a way that complies with both regions' rules, which raises the question, Ambassador Tim Cook, how does he play the increasingly fraught relationship between U.S. and China in general, but more in particular, about how he deals with two polar opposite development spheres of artificial intelligence?
My big question is, how do they censor out and filter AI output that the Chinese government says you cannot look up in China? That's going to be incredibly challenging, and it's going to stammer free speech.
That's the challenge that all tech firms face if they want to operate in the world's second largest economy. Let's talk about Apple and Google restoring TikTok to their app stores, with the Attorney General Pam Bondi assuring the tech giants that last month's ban won't immediately be enforced. President Trump giving TikTok another 75-day grace period that began back on January 20th.
Meanwhile, ByteDance keeps saying that TikTok is not for sale. So longer term, this hasn't given much clarity as to what the future of TikTok's U.S. branch really holds. Nonetheless, what is very clear, and this actually talks about the Gulf of America, or when we talk about this, tech companies are taking him literally at his word, and they are complying with the orders as they are prescribed.
Well, the information yesterday said that the TikTok CEO hints at cuts as talks with Trump continue, the Trump team. I was told that actually the individual in the Trump orbit that's going to be dealing directly with Shou and TikTok is J.D. Vance.
Interesting.
And they only have a short amount of time here. Basically, everything's happening with this administration in April. They have to shore up what's going on with TikTok, the tariffs. That'll be after the March budget on the Hill. They try to get through their tax cuts and reconciliation. April's going to be a huge month.
They're moving so quickly. It's amazing to see. It's week 4, by the way. It's week 4. President Donald Trump looking to reshape foreign policy from the Oval Office.
The Ukraine war has to end. The young people are being killed at levels that nobody's seen since World War II. And it's a ridiculous war, and it has to end. We had a good talk with President Putin. I had a good talk with President Zelensky. Very good talk. Look, it's not a question of liking Russia or not liking Russia. It was the G8. And I said, what are you doing? You guys, all you talk about is Russia, and they should be sitting at the table. One of the first meetings I want to have is with President Xi of China, President Putin of Russia, and I want to say, let's cut our military budget in half. And we can do that.
Trump making headlines ahead of expected comments from Vice President J.D. Vance at the Munich Security Conference later on this morning. At that conference, Bloomberg's Ollie Crook joins us now for more. Ollie, we're all anticipating the words of the Vice President of the United States. Can you walk us through what the conference is expecting from him?
Yeah, listen, it really sort of divides opinion when you ask people here. I think overall, I spoke to one very senior member of the EU Commission who basically likened the Trump call with Putin and all the sort of American approach to negotiating with the Russians. I can't repeat exactly what he said, but he basically said that it was close to being authored by the Kremlin, and that basically he expects J.D. Vance to dial some of that back in this speech. If it were my money, I'm not sure I would put it on that, because most of the people I speak to are expecting a sort of wrecking ball level speech from J.D. Vance when he takes the podium here. Just to give you an idea of who is in the audience here, you have world leaders, you have everybody at the sort of EU Commission level, you have CEOs, not just of defense companies, of all the companies around Europe. They've all come here to hear it straight from the horse's mouth, and potentially this new regime of foreign policy from the United States that the Europeans are slowly waking up to and figuring out basically how they're going to have to deal with it. And that is what they're going to be watching for here. I've spoken to defense CEOs. They're going to be listening very, very closely in terms of what the U.S. posture is going to be going forward. All of this stuff is going to reorder how these CEOs think about their business. And of course, from the European policy level, they have really just not caught up with the new reality, basically that at least for 4 years, maybe for longer, multilateralism is dead. We're talking unilateralism under Trump.
Oliver, when it comes to the peace agreement, where is Europe? Do they even have a seat at the table?
The answer to that is it seems not, right? And when you have these sort of officials coming here, and when we were talking about this last week and early in the week, the idea was, maybe Keith Kellogg is going to come here, start to present some of these ideas to the Europeans, seek their input. It seems to me, at least as what I can tell, the Americans are here to talk. They're not here to listen. They're here to present what their plan is and basically send the bill to Europe. Again, this is going to be sort of what we're going to be gauging from J.D. Vance's speech, and this is the real fear for the Europeans, that this train is already leaving the station. We were just thinking about it. Trump has not been president for more than a month yet. It's been less than a month. And imagine the sort of flow and the cadence of what has happened in the conversation around Ukraine over even the last few days. More has moved than has over the last few months, potentially over the last year.
Incredible how quickly things have moved. Ollie, appreciate it, sir. Thank you. Bloomberg's Ollie Crook at the Munich Security Conference as we all await those comments from the Vice President of the United States, J.D. Vance, a little bit later on this morning. This has moved so quickly in just a few days. As Ollie said, and he put it right, we've seen more movement here in the last week or so on this front than we have in the last year.
And it raises questions about what barriers have come down, why suddenly people are so willing to come to the negotiating table. Clearly, Donald Trump has taken the reins here, and he is getting aggressively involved, and he's saying you can't negotiate if you're not even talking. And he's opening those discussions. There's a lot of pushback. At this point, he's trying to even bring China into the fold to help make this come together. So a lot of pieces in this mix.
Let's extend the conversation now with Heidi Crebo-Rediker of International Capital Strategies. Heidi, welcome to the program.
Good morning.
War has an obvious price. Peace does too. Can we talk about the price to pay for peace?
So I think the price is really on the table right now. Very good questions about Trump opening with a charm offensive, basically, and not inviting Europe to the table. So this is essentially what Putin wanted to begin with, to basically have a bilateral with the president of the United States to negotiate certainly without Ukraine, but without Europe at the table as well. And I think the price to pay is what Europe is willing to actually bring to the table in terms of finance for the war going forward. I don't actually think that a lot of the comments coming out of Presidents Trump and Putin and Zelensky yesterday, especially what Secretary of Defense Hegseth said, I don't think it increases that the likelihood of an effective ceasefire in the coming months, because I don't think the question really was Putin's willingness to come to the table. It's really, can he deliver a ceasefire on what terms? And the terms that Russia wants are certainly going to be very different than the terms that Ukraine wants.
For Trump, though, is this him trying to offer somewhat of an olive branch, or rather an off-ramp, to at least get Putin at the table?
Sure. I think that as I would look at it, it's not only an olive branch, but it is the opening with a charm offensive to try and talk the language that Putin talks, which is great powers talk to one another. And that is another reason why I think that President Trump invited Xi to the negotiating table. But at the same time, you're building up this leverage in the background with Secretary Scott Bessent going just ahead of these meetings at the Munich Security Council and these conversations to negotiate an economic agreement of sorts that would help align some of the economic incentives with what Ukraine has in the ground, which are significant resources in critical minerals and rare earths.
Heidi, I'm glad you brought that up because you were very prescient on this issue. You wrote in the CFR, the Council on Foreign Relations magazine, about this just days after Trump's inauguration. You said how Trump should be talking to Ukraine specifically about critical minerals and how it could be one huge pillar they can use to get a peace agreement. How could you see the contours of a critical minerals deal between the U.S. and Ukraine actually working out?
So I think at this point, and you have to sort of bring it out to a larger geopolitical context, the geology these days, i.e. who has access to some of the critical minerals and rare earths, is entirely geopolitical. So you have borders that line between Ukraine and Russia that actually cut through some of the richest rare earth mining grounds and actually the production capacity as well. And so where those lines are drawn actually matters. Even in Ukraine proper, you have, within Ukraine's territory, some of the largest titanium reserves, lithium reserves, natural graphite. And you have to keep in mind, China's been tightening the screws along the way the past year, which specifically restricting some of the critical minerals and rare earths that Ukraine has in abundance. So looking at economic security and aligning the America First interest of the United States with Ukraine is actually a very good part of Ukraine's potential leverage and a good way to make sure that Russia and China don't have access to those strategic materials moving forward.
Heidi, just finally, I'm surprised how surprised the Europeans appear to be at the Munich Security Conference today. We caught up with Mark Rutte, the then Dutch Prime Minister, more than a year ago, who said that Trump was right. He was right to push them to spend more on defence, and they didn't do enough. Heidi, why are they standing there today so shocked by some of the words that's coming from the administration when so much of this was telegraphed for much of the last 12 months?
So it's longer than 12 months. I mean, I think Europe knows it needs to actually become a lot less fragmented defense industrial complex. They need to have coordination. They need to ramp up their spending in a very, very big way, because at this point, it looks very unlikely that you're going to have the U.S. administration foot the bill in the way that we saw over the past 3 years for the military support that Ukraine is going to continue to need. The good news for Europe is that if they focus on a lot of the drone technology, which is really Ukraine's calling card right now, and how they're achieving with less manpower success on the battlefield, that you can actually do it at a lower cost. So I think to the extent that the Europeans can actually look at what the future of warfare is bringing to the battlefield right now in Ukraine's favor, then I think that they can actually foot the bill. They just need to step up to the plate and do it.
Heidi, appreciate it. Your insight and your opinion. Thank you. Heidi Crebo-Rediker there of International Capital Strategies. Let's get you an update on news elsewhere with some stories this morning from Danny Berger. Hey, Danny.
Hey, John. The Manhattan U.S. attorney ordered by the DOJ to drop the corruption case against New York City Mayor Eric Adams has resigned. Danielle Sassoon wrote an 8-page letter to Attorney General Pam Bondi defending her office's handling of the case. She said she saw no good faith reason to drop it. Sassoon was joined by other senior Justice Department officials who also submitted resignations. 3 veterinarians have tested positive for bird flu infections, suggesting a potentially wider spread of the virus. A CDC study found the virus reached unknown places, animal and people, with more than a dozen U.S. states reporting infected cattle. Health officials have updated testing guidance for farm workers and advised people to take preventative measures. Elsewhere in sports, Aaron Rodgers' tenure with the Jets has come to an end. The team informed the quarterback he won't be returning next year following their 5-12 record last season. Rodgers started all 17 games for the Jets in 2024 after his injury-shorted debut season, throwing 28 touchdowns and 3,900 yards. That's your brief. John.
Danny, thank you. More from Danny in about 30 minutes. Up next on the program, making U.S. manufacturing great again.
In Pennsylvania, U.S. steel is through the roof. They're all through the roofs. We have to have chips made in this country. Right now, everything's made in Taiwan. We want those companies to come to our country.
Sarah Bianchi of Evercore. Up next, live from New York. You're watching Bloomberg TV. Get retail sales at about 40 minutes time. Equities at the moment negative by 0.16% on the S&P, and the bond market going nowhere. The 10-year unchanged, 452.88. And a surveillance this morning, making U.S. manufacturing great again.
In Pennsylvania, U.S. steel is through the roof. They're all through the roof. I think it's going to do great. But I think maybe more than anybody else, the steel companies and aluminum companies, they're in love with what's happened. And this will eventually be the car companies and chip companies. We have to have chips made in this country. Right now, everything's made in Taiwan practically, almost all of it, a little bit in South Korea. We want those companies to come to our country.
So here's the latest. U.S. trading partners preparing for President Trump's reciprocal tariff plans after signing a measure to issue customized levies for each country. Sarah Bianchi of Evercore writing, Trump is launching the plank of his trade policy that is a structural economic reform designed to rebalance trading relations and incentivize reshoring of production. We still think tariffs are headed higher. They're not as high as Trump's threats. Sarah joins us now for more. And Sarah, in many ways, that's why this equity market has rallied. When you say higher, just how high? What kind of numbers and on who?
Well, it's hard to say, and we have a long way to go. But President Trump took tariffs from China from about 3% to 10% in his first term. But we think those could go meaningfully higher over the period, as high as 20%. We do see things going higher around the world. But I think the equity markets are, as you mentioned, delighted to see that this is going to take time and subject to negotiation. So this isn't like the first tariff thing that we saw on Canada and Mexico, where it's used for a different purpose around fentanyl and immigration. This is his attempt to make structural change.
But Sarah, the bark doesn't match the bite. We're hearing tons of grievances from the president when it comes to places like the European Union. He's less so listing all of his irks with China, yet China's the only tariffs at this moment that are actually in place. Why is that?
Yeah, it is a little bit strange that he has started so quickly with U.S. allies like Canada and Mexico and the EU. I think there's a lot of complexity in the China relationship that needs to be addressed. He's obviously trying to get a deal in and around TikTok. He needs some help on the foreign policy front. So that's a longer conversation that may need to happen. But I do expect the steel tariffs will go in. That's something that's also always mentioned to him. But look, we're only at, step one, even though it seems like it's been a lot of activity. There's a lot more to come from President Trump on tariffs.
Sarah, I want you to elaborate on how you see tariffs pushing this reshoring agenda, which would run contrary to this theory that's been put out there recently that maybe he actually wants to bring the walls down everywhere and take him at his word. He wants fair trade. And if, say, Europe removes some of those tariffs, then the U.S. won't implement the extra ones. Why do you reject that concept of the negotiating tactics and, frankly, what the ultimate goal is?
Well, Trump has so many different goals with tariffs, it's often hard to sort them out. One of them is fairness, as this initiative, and another one is a reshoring. I think he would probably answer your question by saying mostly that we're getting a bad deal from some of these countries and that the reciprocal tariffs will inure to our benefit in some way, particularly if he's going to count the VAT tax and other things that could really have an impact here. So my guess is on his mind, reciprocal tariffs does lead to higher tariffs in other places. But to your point, I think there's a lot of skepticism among investors and economists that these actions are going to lead to reshoring. I think a lot of people are much more concerned about it leading to high prices. You saw the Ford CEO speaking about that yesterday. Steel and aluminum, these are inputs. In Mexico, there's a lot of production. So there's a lot of different impacts here and not always, unfortunately, as simple as perhaps the president implied in his remarks.
Well, Sarah, you most recently served as the deputy USTR. When you have a president that's putting out a ton of different ideas when it comes to reciprocity and trade, how much leverage does his individuals in the room when they go for these negotiations have?
Well, the United States always has a leverage. Certainly, it's going to be challenging for the United States Trade Representative to negotiate with every country at once. So I think it's a little bit challenging to imagine that we're going to get a series of great deals on reciprocity. Look, I've worked with Jamieson Greer. He knows this space very well. I think the USTR will be ready to go, but it's certainly hard to, again, solve for this many different issues at once.
Sarah, appreciate it. As always, Sarah Bianchi there of Evercore. Annmarie nailed it. The bark doesn't match the bite, and right now the squeeze in equities continues, at least so far this week. Up next, Peter Tchir of Academy, Daan Ives of Wedbush, Lindsey Piegza of Stifel, Amanda Lynham of BlackRock. The next hour of Bloomberg Surveillance just around the corner.
Tariffs are the wild card this year. It is what everybody is talking about.
Policy is sort of rolling out, and consequences and decision nodes are happening in real time.
The question is, are there any carve-outs to those tariffs? The inflationary effect will be less the more you get carve-outs.
If we see some really big increases in inflation, that's going to be very disturbing.
There seems to be a lot of panicking about it, but maybe we need to kind of be more rational. There's a lot of devil in the details.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Okay, so a big hour coming up, so let's get to it. Your scores look like this. Equity futures down by about 1/10% on the S&P. On the Nasdaq 100, negative by 0.15%. In about 30 minutes' time, we'll get you some economic data, U.S. retail sales, and at some point this morning, perhaps even in the next hour, we're going to hear from the Vice President of the United States, J.D. Vance, addressing the Munich Security Conference. This could be a big address from him.
The expectation is that he will be speaking to the European Union in terms of free speech, in terms of some of the recent political developments in the region, and then, of course, on how to achieve a Ukraine-Russia peace at a time where they don't seem to be at the table. Key question is, and this is something that Ali kept talking about, Oliver Cook of Bloomberg News, he kept saying a lot of people are expecting a really harsh speech where it basically is just throwing down the gauntlet. How much more can he lean into what Donald Trump was talking about?
He will definitely lead with America first, and that's this administration's North Star. But overnight, he did give an interview to the Wall Street Journal. And this is how the Wall Street Journal starts that. Vice President J.D. Vance said that the U.S. would hit Moscow with sanctions and potentially military action if Putin won't agree to a peace deal. So you see potentially the administration starting to pull back just slightly on what Defense Secretary Pete Hegseth had to say about NATO and putting more of a maximalist approach when it comes to Putin.
The prospect of peace has helped to lift the euro throughout the week. We're on course potentially for a fourth consecutive day of euro strength. And also the tariff story. The tariff story, I think you put it perfectly in a previous hour. The bark hasn't matched the bite. And as that kind of spread still exists, this market and that squeeze higher just continues.
Well, and at this point, people were looking for some sign, and I keep going back to this, of what the goal is. And we talked about, Sarah Bianchi highlighted this, there are many different goals. It seems as if the goal of reciprocity is actually easier for this market to digest than the role of really reshoring and isolating the United States. And they are not compatible, because if they drop their tariffs to be fair and reciprocal, ideally, in some words, this actually goes to free trade.
Equity futures just a little softer at the moment. We're down 0.1%. To Lisa's point, European autos keep creeping higher every single day so far this week on a Stock 600. Coming up this hour, we'll catch up with Tchir of Academy Securities as markets navigate White House headlines. Lindsey Piegza of Stifel reacting to this week's hot inflation data. And Amanda Lynham of BlackRock on the Fed's higher for longer regime. We begin this hour with stocks higher. Investors breathing a sigh of relief as President Trump decides not to implement reciprocal tariffs right away. Tchir of Academy Securities saying maybe we need to squeeze some shorts, but I suspect we're going to see tariff-related headlines that spook the market as early as the next week. Pete joins us now for more. Pete, good morning. It's good to see you. What happened yesterday? Should we start there?
Yeah, I feel like it wasn't really Donald Trump speaking. I feel like he got sucked into by his advisors to come up with this very mellow message, right? If you think about Trump, it's we're going to take over Greenland. Canada should be the 51st state, right? There's no nuances about, well, Quebec doesn't like Ontario. He's always very aggressive, even on the initial set of tariffs. So I feel like the rest of the world is kind of like, okay, what was really said? And I do think tariffs resonates with people, trade protection resonates with people. I'm not even sure VAT resonates. So I feel that sometime next week he's going to be like, no one's taking this seriously. I'm not going to listen to my advisors. I'm going to go back to being myself, and I'm going to send a clear message.
I'd love to have Putin back in the G7. Russia should be sitting at the table. That was the restrained version of the president yesterday.
So that was an interesting one. I think it's, again, you go back and why Russia was brought into the G7 or G8 at the time was, okay, maybe if they work with us, you'll move forward. I think it's a little bit incorrect right now because there should be some sort of punishment for the invasion. And certainly this is going to send Europe, in a tizzy, right? Europe's not going to be comfortable with this at all. Europe's not comfortable with any form of peace right now, let alone bringing him back. So again, I think there's all this friction, and I think people have been very
Hold up,
calm.
let me jump in. Europe's not comfortable with any kind of peace right now. Can you translate that? Because that just sounds shocking to people. What does that mean?
I think Europe, much more than us, is very worried about if you give Putin an inch, you've given him a mile. And that's any sort of accord that gives Putin time to, take his win, consolidate, leads him coming back for more in 2 years down the road. That's, I think, very prevalent within Europe. It's a thought that's much more concerning to them. And they are sitting there much closer to the front lines. So I think their view of a peace is very different than ours.
Which is the reason why a lot of the commentary that we hear out of the European Union, as well as analysts in the United States, is this doesn't really move the needle further towards some sort of peace agreement that is viable and long-lasting. You have a lot of generals at your firm, at Academy Securities. Do they agree, or do they think that actually having conversations is a really solid step, just like the market seems to imply?
So we think there is going to be a deal done this year. I think whether Europe likes it or not, it's going to happen. We think that the Russian frozen dollar reserves are going to play a big part of that. So that's going to be the carrot and stick, right? Putin, we could try and fight you and keep all these dollar reserves, or we can give you some back. And if you make peace, Ukraine, you get a bunch of dollar reserves to give up some land and do the rebuilding. So I think that's a big part of it. There'll be some sort of vague path for for Ukraine to head towards NATO that Putin probably won't believe in. And there's a chance, right? If you pull people together, I think most of our generals, again, I think one of the more interesting questions we've been asked, period, what would you do most as a general to ensure peace for the U.S.? He's like, fund the State Department more. So I think talking and engaging with countries, that's a way to pull it together. So I don't know that there's an obvious lasting peace, but if you stop the war, you get people talking, there's that potential.
Markets are sniffing this out, and there's a question of how much that is giving sort of a turbocharged effect to some of the optimism that we heard a couple months ago about the euro. Maybe things have gotten so bad they can't get any worse. Do you lean into that? And it's not just with Europe, but also with China, that if there is discussion and there is some semblance of deal making, that maybe that could actually reignite some of the growth in the rest of the world, not just the U.S.
So at the start of the year, we were very adamant. We called it geopolitical opportunities and risk. And I think everyone talks about geopolitical risk. We felt there'd be some sort of resolution this year in Ukraine, Russia. There'd be some sort of resolution with Iran, Israel. Those are going to be very positive for those regions. I think Germany can actually, this might help Germany out of the slump, especially if Ukraine's given these dollar reserves to rebuild. Poland, I think, is going to be a huge beneficiary of this. I think in the next few years, you're going to see Poland's importance grow more and more. And even when Vance talks about pulling troops out of Germany, at least in the past Trump administration, it was pulling troops out of Germany and putting them in the Baltics, putting them in Poland for two reasons. One, closer to Russia, so more important. And two, this goes back to Trump. Having a U.S. military base in your country provides huge economic benefits to that country, right? The military spends money. The people there spend money. So if Germany's not spending their 3%, let's give it to the Baltics, who are spending their 3%. Let's give it to Poland, who's done a lot. So I think there's going to be a lot of, thought about this, and it's not simplistic.
Do you think that maybe then the long dollar trade is crowded? Because right now what we're seeing is actually a push toward the rest of the world. Get your house in order. Yeah,
so I would say right now the portfolio we're recommending people is very contrarian, but we still like, despite all the friction that we see with China, despite China as national security threat number one, FXI and KWeb, I think, are going to continue to do well. They're heavily under-owned. China's trying to do its own thing. Trump seems to back off on them periodically. I think that could explode higher. I like European stocks. And I do like the chip makers in the U.S., but I like the ones that can be domestic chip makers. I think you're seeing more and more of this. We've been talking about it since day one of Trump. He wants a domestic chip industry. We need to be able to make chips. That's going to be part of national security. I think that's just starting to take off. And we've seen some, single stock reactions this week that I think are just the beginning of what can come.
Everything you're saying to me, I keep thinking Trump is very transactional. This nuance, this idea of pulling troops out of Germany, but not to pull them out of Europe, but put them in the Baltics. Isn't that what the Europeans are? Going back to Jonathan's point, Trump yesterday saying he'd like to see Putin back at the table to the G8. Well, Russia was kicked out because of annexation, illegal annexation of Crimea. At the same time, Germany was still willing to build Nord Stream 2 years later.
Yeah, and one thing I would say, I think one thing Europe's getting a little bit ahead of itself. I don't think Russia's coming back to deliver cheap gas to Germany anytime soon. I think Russia's really moved on. They're like, well, China's going to be a better customer. India's going to be a better customer. They're both going to be buying fossil fuels for 50 years in the future. Germany wakes up every day saying we're not going to use fossil fuels ever again, and then uses fossil fuels. So I don't think you're going to see this, return to what it was. That switch has been broken. It's not coming back. I think the U.S. has a better chance of establishing relationships with this. And the other thing I think you pointed out earlier is, tariffs. Trump is going to be carrot and stick with everyone. Here's what you get if you behave nicely. Here's what and that may work. It may backfire. That's going to be the big question.
So right now, what do you think he wants, his major concessions when it comes to tariffs?
I think he does want something that allows U.S. manufacturing to grow, something that makes it easier to build things here. And of all things we look at, I think the one he's most committed to and the one where we might get subsidies is the chip industry. I think everything else would be nice. I think that's a must-have. And so when you think about must-haves, it's the chip industry.
You said the G8. Who said it would be the G8?
You're thinking Canada gets kicked out because they'll be part of the 51st state, so then it's still the G7?
I'm just staying open-minded about
I know that's what you're thinking because you said it to me yesterday.
Look, the pressure was building in the news conference again on Canada yesterday, wasn't it? What's that all about?
I think, again, that's why I found what he says about Canada, for example, versus what he did on global tariffs so interesting. So if you're Canada or Mexico right now, or even to some extent China, you're still facing the first round of tariffs and your fentanyl negotiations. Then you got slapped with 25% on aluminum steel, and now there's this vague talk about reciprocals and VAT. What are you even negotiating now? I think his message was too muddled yesterday. I think markets took it comfortably because, okay, this isn't going anywhere. I think that's where he gets disappointed in the next few days when people don't show up to kiss the ring, don't come saying, hey, President Trump, what do we need to do? And that's when I think he ups the rhetoric, because he does want people to come to the table. I just don't think yesterday's message brings people to the table.
Right now, the market's not taking it seriously, that's for sure. Pete, it's good to see you, as always. Peter Tchir there of Academy. Headline just crossing the Bloomberg terminal here, Bramo. And this Saudi Arabia expressing a welcome to host the Putin-Trump summit.
And we were saying that this would actually be something of a game changer if we did get some sort of sit down between these two. It looks like they are willing to make this happen.
Not even willing. It is happening. Next week, you're going to have potentially at the highest level with national security advisors meeting between all four of these countries, Saudi Arabia, Russia, the United States, and Ukraine, in Saudi Arabia to start to set the table of what a peace agreement and what a summit would look like.
You can't tell people what I tell you privately. Let's get you an update on stories elsewhere. With your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John, I'll save you both from this conversation. HSBC kicking off a fresh round of job cuts at its investment bank as early as Monday. People familiar with the matter telling Bloomberg that the latest phase of cuts will start in Asia, but ultimately affect employees globally. HSBC will provide more clarity on the scale of the restructuring when it reports full-year results on Feb 19th. Ukraine's President Zelensky says that his recent phone call with President Trump was positive. He said his country is ready to discuss any means necessary to stop Russia's aggression, maintaining that President Putin doesn't want peace. Zelensky also reiterated that continued support from NATO is the cheapest way to protect Ukraine. Starbucks is set to open 500 stores in the Middle East in the next 5 years. The chain is looking to bounce back after challenging conditions and consumer boycotts. CEO Brian Niccol telling Bloomberg's Jomana Bercecci that the company is also ready to adapt to possible tariffs.
As environments change, regulations change, laws change, obviously our job is to figure out how to navigate successfully through all that change. And I think we've demonstrated over the history of Starbucks we're pretty resilient when it comes to dealing with change, and that'll continue to be the case going forward.
Starbucks also plans to add a few thousand stores in China despite a competitive environment. And that's your brief, John.
Hey, Danny, thank you. More from Danny a little bit later this morning in about 30 minutes' time. Up next on the programme, the Morning Calls Plus, Dan Ives of Wedbush with Tesla under pressure to start the year, and Meta absolutely flying, up for 19 consecutive straight days. We'll get into that in just a moment. From New York, you're watching Bloomberg TV. The last big data point of the week coming up in just a bit, 15 minutes away. US retail sales just around the corner. Into it, the scores look like this. Bond yields unchanged, 10-year 452.69. Back and forth, Wednesday up by 9 basis points, Thursday down by 9 basis points. CPI and PPI coming in hot, but it's okay because the components that go into PCE mean the Fed doesn't have to be too worried. What do you make of that?
Right now, people are looking at what the Fed looks at, and frankly, Fed Chair Jay Powell leaned into this when he said, well, you know, inflation's running at 2.6% after we just got this incredibly hot CPI print that was much above that. Key question I have is, does this mean that people are dismissing some of the hotter than expected prints as noise when they should be taking them seriously, if not literally?
It means the Federal Reserve might be, and that's why gold might be trading higher still, another all-time high earlier this morning.
It's the reason why Jim Bianco thinks we could get a 10-year yield around 5%. Look, we'll see. We're about to get a retail sales print that's probably negative, and we're going to get a lot of people on that come on and tell us why it's just noise. So if you're feeling a little bit nauseated by all of the volatility, well, join the club, and it's really going to be listening to what the companies have to say, how much pricing power they actually have, and how much confidence they have about earnings.
29.29 on gold right now, very close to 3K. Are you just summarising what everyone's going to say over the next hour or so? Is that the coverage of Bloomberg TV for the next day?
Well, it's true. We're going to get a negative read, and people are going to say it's autos, and the autos weren't as great, but still, it's just noisy, and let's look forward.
Keep buying stocks.
Okay.
All-time highs at a close. That's what they might say.
Yeah.
Let's turn for the morning calls. First up, Bank of America cutting its price target on applied materials to 205, citing a more cautious view on China. That stock is down by close to 5%. Your second call from Goldman, upgrading Airbnb to neutral, pointing to the potential for margins to stimulate growth. And finally, JP Morgan raising its price target on Roku to 115, saying its year of monetization is off to a strong start. That stock is up big time, up by 14%. Let's turn to autos. Tesla down over 11% since the start of the year. Despite the uncertainty ahead, Dan Ives of Wedbush reiterating his overweight rating on the stock. Dan joins us now for more. Dan, welcome to the programme, sir. Lots to get through. That name is up in the pre-market just a little bit, but it's had a struggle recently. What is behind that struggle, Dan?
I mean, look, I think it's really the worries about distraction with Doge, as well as maybe some softer numbers that have come out of China, you know, and as well as Europe, right? So I think there's worries about distraction. The Musk, is there brand deterioration? But look, we strongly disagree. I mean, I believe it's going to be known as the bet for the ages in terms of Musk on Trump. And when it comes to autonomous, That's worth $1 trillion. That continues to be the golden goose. That's what they're focused on. So I think any of this is sort of near-term noise into just what's going to be a massive period of growth for Tesla.
Well, it's not all noise. So let's get to some of the signal. Talk to me about the challenge to autonomous driving, the challenge posed not just from, say, Waymo, but also from BYD. How strong is that challenge?
Look, it's a challenge, but I think the biggest issue is that in the U.S. there's really no federal roadmap. I mean, the whole point here and why it was so bullish in terms of Trump and Musk, ultimately, this is now going to lay out on the federal side a roadmap for autonomous. Now, look, there are challenges. You look at what's happened in China as well. But I think that's something that ultimately Tesla is going to be massively competitive when it comes to everything in China. That's going to be a huge, strong market for them. And there's nothing that makes me view this as a zero-sum game. I mean, we're in the beginning of what's going to really be, trillions of dollars spent.
But let's just say, and this might be a hypothetical, and this might be real, Dan, that BYD gets subsidized by the Chinese government in order to make enough inroads that they can offer cheap data and cheap technology that achieves some of what Elon Musk is promising, but a much lower price point. Why wouldn't that cannibalize from his potential demand significantly in one of the biggest markets?
Yeah, look, is that a headwind? Yeah, no doubt. I mean, is there some cannibalization? But I think it just comes down to they produce the best product out there. I mean, when it comes to their cars, in terms of Tesla, and it comes to ultimately what they're going to have when it comes to autonomous, that's a brand that's, I think, going to go through all that noise. And I think they're going to continue to ultimately gain share in China. And I think when I look at the U.S., despite some of maybe contained brand issues, when I look at autonomous and robotics, I mean, that's 90% of the story going forward. So any of this near-term worries, I think the bar's going to be a lot worse than a bite in terms of where just this broader innovation's going. I believe the best is ahead for Tesla, not in the rearview mirror.
Contained brand issues is the most interesting way of saying that people don't like Elon Musk. There are a number of people who love him, and there are a number of people who hate him. He's very much in the public sentiment. How much can you dismiss that at a time where you have Oppenheimer analysts coming out, Stifel also saying that, frankly, the negative downturn in consumers' perception of Elon Musk could result in a headwind for sales? Why is that just a contend perception risk?
Well, first of all, the haters always hate, right? So, I mean, they're always going to grab onto something that ultimately will be negative for Tesla. When I look at ultimate numbers, I mean, I think it's contained. And look, will there be some brand deterioration here? There could be some. But the reality is that the reason it's going to be known as the bet for the ages, because Musk having that front row seat in the Trump White House is significant in terms of autonomous, deregulatory environment. And that's the key. So any small brand issues, which I believe are contained, it's still what I view as far and away, and is not even close, the best EV and one of the best really automobiles in the world.
Dan, who's running Tesla?
Look, Musk continues to run. And we've talked about it a lot on the show. I mean, even if you go back a few years ago in terms of everything with X and Twitter and some of the distractions, I actually think this is an engaged Musk behind the scenes in terms of Tesla. There is a much stronger bench today.
Dan, how does he have time for that? I've got to jump in. How does he make the time to do that? That's amazing. Where does that time come from?
Look, first off, he definitely has a lot more what I view as a bench at Tesla to run a lot of these products. So maybe a few years ago, he was sort of doing it all, I wouldn't say himself, but I think now there's a lot more activity that goes on without him. That said, most of the innovation that's coming to Tesla over the next 6 to 9 months, there's so much more innovation coming ahead than behind, and Musk is going to be key to driving that. Now, look, with Doge, is that a distraction? Is that going to cause definitely some negative brand issues? Yeah, it could. But the reality is, in terms of the benefits, far outweigh any of the negatives for the broader Tesla story.
I remember when people used to complain about Jack Dorsey being across Square, then Square, and Twitter. Do you remember that?
Yeah.
Elon Musk is phenomenal. How many companies he's across right now?
He must not sleep because he's got X,
right.
XAI. X evidently just increased their revenues, according to New York Times reporting, by 40%. You have to think he's got sleeping pods over...
The energy of him and the sitting president is just incredible.
Well, I just wonder, how much can he be on top of some of this innovation if he's doing 10 other things. I'm just saying humanity does have its
Well, you know,
limits.
he's sleeping on the floor of the Doge offices. Apparently, that's according to the Wall Street Journal.
That's what he did on the factory floor at Tesla and turned the company around. It's absolutely amazing. Dan, I wanted to finish up with Meta. Meta's on a 19-day run. That's just stunning. It's unheard of. It's a record for the stock, a record for the company. Dan, what's behind that? What's with the insatiable appetite for that stock?
Saquon Barkley attack, right? I mean, if you look at what they've been able to do, I mean, it's really now about monetization of the billions of users. They're doubling down on AI. Advertising looks strong. And I think this is a company. They are in what I believe is going to be a massive period of growth. And I think it's actually just starting in terms of this new Zuckerberg and the new Meta. When it comes to AI, they're going to be one of the bigger winners in advertising. And this is a stock that could be a 4-digit.
Both a Penn State guy and an Eagles guy. Dan Ives of Wedbush. I hear you. I know where you're coming from. Dan, thank you. The latest there on Meta and Tesla. What a run by Meta.
And it comes after they explained how they will continue monetizing their billions of users with much more targeted advertising that they can charge a much higher cost for with artificial intelligence. This, to me, is the monetization that a lot of people have been waiting for and the reason why it's being rewarded.
We've talked a lot all morning about the trade issue and how the market might be potentially underestimating how serious they are about some of these tariffs, and we'll see what happens on April 1. What we need to talk about more is whether the market's also underestimating the Doge effort. I think this president and this administration is very serious about cutting costs. And when you hear him talk about military spending, I don't think he's joking. I think it's for real. He would love to see that. We're running a budget deficit in this country north of 6%. Last year, I think about 6.5%. $800 billion, north of $800 billion going to defence. If you want to do something on the deficit and you're serious about doing so, you've got to do something about defence spending. If you want to do something about defence spending, you've got to go out to the other big defence spenders and say to them, we're spending money because of you, you're spending money because of us. And that's ultimately the argument the president was presenting yesterday.
The reason why people aren't paying a lot of attention to the tariffs or to the Doge effort is because a lot of the proposals counteract each other and are at crosswinds with each other. And so it's hard to pick up which ones you should pay attention to, which is the reason why a lot of people just keep looking at the specific companies and saying, OK, these numbers make sense, I'll buy that.
How realistic this effort is, that's your judgment call, but that's the logic behind the argument coming from the president at the moment. Up next on the programme, breaking retail sales plus. We're awaiting those comments from the Vice President J.D. Vance at the Munich Security Conference. When they begin, we'll bring them to you. Happening right now at the Munich Security Conference, the EU Commission President Ursula von der Leyen saying we need a surge in European defence spending. Shortly after this address wraps up, we'll hear from the Vice President of the United States, J.D. Vance, live from Munich in just a moment. When we get those comments, we'll bring them to you. In the markets at the moment, equity futures just about negative by 0.1% as we await US retail sales. With the numbers, let's bring in Michael McKee. Good morning, Mike.
Good morning, John. Let's see what we've got here. Retail sales, bad month on a headline basis. We'll have to look at the core. The retail sales advance down 0.9. The forecast was for a drop of 0.2. Ex-autos down 0.4. Ex-autos and gas down 0.5%. Retail control hasn't come through yet. I'll get that for you as soon as it does. The import price index, meanwhile, up 0.3 on the month. Take out petroleum, it's only up 0.1. So the inflation concerns that we sometimes see are not coming through. But it does look like retail sales are a disappointment. And if you take out cars, it's still a disappointment. So we'll have to see where the problem is. I will dig into the numbers here and get the details for you.
As you dig into those numbers, the control group crosses, Mike. It comes in at negative 0.8%. The number we were looking for, Mike, was 0.3. And as you know, Mike, that's the number that goes into GDP. I'll use your word, that is bad. And I'll look at the bond market. Yields are down by 3 or 4 basis points. The 10-year 449.37. The 2-year here is down by 4 basis points, also to about 426. So we're heading back towards the low end of the range on a 10-year for the year so far. At the very low for 25, just about 440. At the high, of course, about 480. Off the back of that move in bond yields in the FX market at the moment, let's check out euro dollar for you. On a 3-day run of euro strength coming into today's session, some more euro strength approaching once again 105, 104.94 right now on my screen, up by a third of 1%. As we count you down to the opening bell, also a check of the equity market. Equity futures still softer on the session, but no real drama here. We're down by about a tenth of 1% on the S&P. But Bramo, that is a downside surprise on US retail sales.
And a much more significant one in the fact that even when you strip out autos, which we thought would be noisy, you still have that downside surprise. The one caveat, and maybe the reason why you're not seeing a bigger reaction in markets, is because the revisions to the prior month were significantly higher than previously reported. So that was revised up about the same amount that some of these metrics were revised down, or at least close to it. So again, it's a sort of push-pull of the internal dynamics of this data.
Mike, if you're still there, I hope you can jump back in. Any detail on what's behind this number?
Well, I'm trying to pull up most of this stuff right now. The Census Bureau website wasn't working particularly well, which is not a surprise. But let me pull up the table here for this. I can tell you, in terms of import prices, that import air passenger fares for the month were down 12.8%. That's going to put a lot of downward pressure on the PCE that comes out. So even though we saw some inflation in the other numbers this week, we're going to get some good news out of the overall PCE. The Fed will be in a little bit better shape. Okay, here's the breakdown for the numbers on the retail sales. Motor vehicles down 2.8%, furniture down 1.7%, building materials down 1.3%, and food and beverage stores down 0.1%, groceries up 0.2. So not much help there, and sometimes we get that. Gasoline stations were up 0.9 on the month. Department stores up by about 0.8%. And non-store retailers, this is where the real weakness appears to be, down 1.9%. Now, the one other caveat is that the retail sales control group for last month was revised up to an 0.8 gain. So over the 2 months, if you average them, we're flat, but they're in two separate quarters. So this starts us off on a bad note for the first quarter.
Mike McKee, appreciate it, sir. Thank you. Joining us around the table, Lindsey, Piegza of Stifel. A whole bunch of headwinds have held back the consumer sentiment. We've seen that be hit in the last month or so. Is it hurting spending?
Well, clearly, I think this number really starts to poke some of the holes into the thesis that we see this ongoing resilience of the consumer. Now, broadly speaking, we continue to see the consumer spend in the marketplace on goods and services, but it's that loss of momentum. It's that second derivative decline of the consumer slowing the pace of still positive expenditures. Now, Lisa, as you pointed out, a lot of this weakness is offset by earlier upward revisions to prior months. That being said, there are clearly still challenges facing the consumer in this environment of higher prices, higher borrowing costs, the resumption of student debt payments. There's still a lot of challenges facing the average American and the average household balance sheet.
I feel like we're whipsawed in terms of a narrative every day. One day it's weakness that potentially could be the biggest headwind to the market this year. The other, it could be inflationary and an upward growth shock. Which is it?
Well, I think it goes together. I think inflation is one of the biggest challenges that we're seeing weigh on consumers at this point. As consumers are forced to face this burden of elevated prices, as they have been for years, that's going to continue to erode their ability to spend in the marketplace. Now, we've seen consumers turn to many of these one-off scenarios, buy now, pay later, turning to credit cards with balances over now $1.2 trillion. But as that burden continues to increase, that's going to ameliorate their ability to find these additional supplements to continue to spend at this pace. So we've gone from double-digit spending down to 8, down to 6. We're now averaging just under 3% since the start of 2023. That's still indicative of a solid 2% GDP pace. But if we slow further from here, that could start to add to the momentum of a stagflation storyline.
So the pushback that we get from the stagflation fears is, if you actually look at the data inside of some of the inflation metrics, it's not that bad, and it's steadily disinflationary, and it really just matters core PCE, which is fine, and everything else is just noise. Do you agree?
I think we've seen a lot of improvement from earlier peak levels. I don't want to throw cold water on the improvement that we've seen, but we are not in a clear disinflationary environment at this point. As of last year, a lot of noise, a lot of volatility in the metrics, and more recently, we've seen not just a move sideways, but upward acceleration for 4 consecutive months in the PPI and the CPI and some of the core metrics. The super core CPI, housing alone, double the 2% target. So with that acceleration, we expect the PCE and the core PCE to remain closer to 2.5%, which still perpetuates the concern then of choking off upside potential for growth.
We're dominated by headlines about policy changes that could be coming down the pike, and we are awaiting a discussion from J.D. Vance. And I'm wondering, from your perspective, how quickly some of what's being discussed could percolate into the economic data and backdrop that you're seeing.
Well, it can certainly add to the uncertainty in the marketplace. It can add to the uncertainty we see in consumer confidence. And I think that was in good part behind that drop that we saw at the start of the year. But in terms of filtering into the actual price data, that, I think, will be extended out probably about 6 months or so, because businesses have already responded in anticipation of those tariffs, of those higher prices. So a lot of that inventory build has already been taken into account. So we're not going to see that filter into the price metrics for some time. But again, it will continue to cause near-term volatility and uncertainty.
Lindsey, it's great to catch up with you, as always.
Thank you very
Lindsey
much.
Piegza there of Stifel. A few things going on here. We've just had US retail sales coming in with a downside surprise for the month of January. Off the back of that, bond yields are lower by 4 or 5 basis points, the 10-year at 448.40. Need to head over to Munich and focus on what's happening over there right now, the Munich Security Conference. Just moments ago, we heard from the European Commission President Ursula von der Leyen. In just a few moments' time, you'll hear from the Vice President, J.D. Vance. Those comments from Ursula von der Leyen pretty clear. We need to spend on defense.
And also taking swipes at the United States. 2 things stood out for me. Trade wars and punitive tariffs make no sense, she says. And that got a huge applause in the room. And she also followed it up with this threat that she talked about. Unjustified tariffs on the EU will not go unanswered. Something else as we await J.D. Vance. She said this: many in the security circles in Europe were confused, some even worried, by the comments made by senior U.S. officials earlier this week. She's not naming names, but she's clearly talking about the Defense Secretary, Pete Hegseth, and the likes, and all this rhetoric coming out of the incoming new administration.
I think it's fascinating that she talks about the need for a surge in European defense spending. That's what I'm interested in.
The Vice President stepping up to the stage. Let's take a listen to J.D. Vance.